ಓಡ್ತಾ ಇದ್ವಿ.
Is income escaping assessment. May I request C.S. Shripad to welcome C.S. Shivsankar sir onto the dais and welcome him with the floral bouquet. C.S. Shivsankar TR is a commerce graduate from Bangalore University. He has completed his BBM in PS College of Business Management. Completed CA and CS in the year 2007 and Diploma in IFRS by ACCA London. He has secured All India 12th rank in CS Intermediate Examination in the year 2005. He has completed his articleship with MSSV and Co and served in MSSV in various capacities. He has represented the clients in various forums including CIT appeals, Income Tax Settlement Commission and before real estate regulatory authorities. He has presented various papers in ICI and other institutions on various topics related to income tax assessments, tax deducted at source, taxation of charitable trusts, penalties under Income Tax Act, etc. His main areas of practice are corporate audit, direct taxation and general litigation. With this brief introduction, I present to you C.S. Shivsankar TR. Over to you, sir.
Good evening, everybody. So, a good weather, the nice just now stopped raining. So, being a chartered accountant, though client can escape the income, so we can't escape learning the things. So that is when we start the journey, being a student of Institute of Chartered Accountants of India. So that is something which we can't escape any subject. You have to take care of all the subjects as equal, like you have to treat it as all your children's. So you need to give the same kind of weightage. Yeah, so today's topic is income escaping assessment. I think this is almost 5-decade old law. So I think in 1922 also the same kind of law was there, income escapement assessment. In 2024, once again we are revisiting the whole provisions of section income escapement of assessment. Today we are going to deal income escaping assessment, the related sections. Totally there are 10 sections. Out of that, 1 or 2 is not so much it is utilized, otherwise also all the sections has a practical implications. I will deal the section wherever it is important. I will not go into each and every line of the sections. Wherever there is important things, I will tell. Along with that, there will be some case studies where there is a practical thing it has already happened or the way we have to interpret the cases. That is how it has been designed. I request you to seek any clarification then and there. So I am not disturbed with your questions any point of time, you can rise. So you need not wait until the end of the sessions. So we will try to make it as interactive as possible. So the first section, income escapement, is income escaping assessment. See, there are some few magical words we need to point out. It says, if any income chargeable to tax. The word chargeable to tax is very important. It is not enough if the income is escaped assessment. It should be income which is chargeable to tax should have been escaped the assessment. Assuming I am an agriculturist. Along with other income, I have not disclosed some agriculture income. Or I am a partner in some partnership firm, share of profit I have not disclosed. Whether that non-disclosure will amount to income escapement of assessment? No. So because it is very clear, income chargeable to tax should have been escaped the assessment. It is not income per se, need not be looked into. And as escaped assessment, subject to provisions of section 148 to 153. See, section 147, 148, 149, each has some child link. 148 subject to 148A, 148 subject to 149, 149 subject to 151. So each one is dependent on other. So it is very important to break that and understand which is dependent on which one. So here is, I will go into subject to provisions of section 148 to 153. Assess, reassess such income, recompute the loss, depreciation allowance or any other allowance or deduction for such assessment here. They can only do so much. They can't do any other thing other than what they are given. Assess or reassess such income, recompute loss, depreciation allowance, any other allowance or deduction for such assessment here. If somebody can think of, is there anything they have left it here? So according to, if I see everything they have covered. So, but there are some instances we will cover in the future. So some of the things which will not come into this section 147. Section 147, there is an explanation what it says, where once they issue the notice under section 148 validly and resume the assessment, during the course of assessment, assessing officer is empowered to add something else which will come to his knowledge subsequently in the course of proceedings. That also he can add. The same provision was there in the earlier period also. There the Honorable High Courts, except Karnataka High Court, held that unless the purpose for which you have opened that is sustained, you can't go into any other things. I have opened for something else. If that something else is not sustained, you can't go into any other things. But as far as in Karnataka High Court is concerned, so that is against to us. So according to me, they were giving as a part of proviso to section 147 earlier. So now they have brought in as an explanation. According to me, whatever the defects was there earlier, they have cured. So they can add something else along with what for they opened. If they come to know some other information or material subsequent to issue of notice under section 148. Here is the case study. An order under section 148 AD of the Act in the case of Mr. A alleging that 60 lakh escapement of assessment year 17-18. In the process of assessment, assessing officer found that another 70 lakhs income escaping an asset is also escaped assessment. Can he assess the additional income of 70 lakhs? As per the explanation, it can be done. So earlier, other than Karnataka, so everywhere you can't do. In Karnataka, they could have done it because of the Karnataka High Court judgment. So next, these are the two things we want to say. What is that income escapement assessment? From where they will get the information? What is that information which suggests that income chargeable to tax as escaped assessment? It is very important. You will see in the presentations around 6 or 7 places information which suggests that income chargeable to tax as escaped assessment. This can be seen from two angles. One is source of information. It is very important, unless the source of information which is given here, if something else they trigger the 148, it is not sustainable. It has to be only this information alone. There cannot be any other information which will made you to issue 148. What are that? One is information in accordance with risk management strategy formulated by CBDT. As of today, I have not seen any circular which says that this is what is the risk management strategy. Even today, but all the notices, almost all the notices has been issued saying that it has been picked based on the risk management strategy. But otherwise, I have not seen 148 any risk management strategy which has been notified under section 147. So this is the good ground for you to take before when you are replying for 148AB or 148DAD. You can think of saying that request you to give me a CBDT circular which says that what is risk management strategy. According to them, is a risk management strategy is a software which normally it will give the information to them. So they have created one software. When assessing officer will come to know from any other officer, he has some information about Mr. X, but jurisdiction affairs with somebody else. What they have to do, they have to feed into that software and leave it at that. Based on that PAN number, it will search the jurisdiction of the respective assessing officer and he will take the necessary actions. That is how risk management strategy works. But as of now, there is no CBDT circular explaining what is the risk management strategy. So this is the good point to take and argue. But there is we have taken in various courts. We have to see the light of that judgment is yet to come. Then audit objection to give effect to the assessment order are relevant. See, earlier they were only talking about final audit objection of the C&AG. When they have introduced in 2021, they were telling final audit objections of C&AG. Now they are telling any audit. Any audit means need not be C&AG audit, departmental audit, internal inquiry, whatever the audit. During that thing, if it is flagged, that is considered as the information which suggests that income escapement of assessment. Then information received under the agreement referred to in section 1991. This is in 2022 they have added. So where from other countries when we get the information based on that we can do it. Then information made available to assessing officer under the scheme notified by under section 135A. This is very important. I think many of us we are missing of this section 135A notice. Now assessing officers are issuing notice under section 133(6). 133(6) what they are asking, we have interest as per your return is so much, but as per the information is available so much. Kindly explain. If you explain, according to there is a notification under section 135A, so they will segregate into high risk, medium risk and low risk. Low risk they will close it, high risk they will directly issue to notice under section 148. We will come to this 135A little bit later. This is not been noticed much. From last 2 months, lot of 148 has been issued based on 135A. Information which requires action consequential order of tribunal or court. So based on any proceedings, we come to know that there is something which is income escaped assessment, they can open. Only in this 5 categories, they can open or issue the notice under section 148. This is explanation 1 to 148. Here is the explanation 2 to 148. Here assessing officer has to prove that he has an information. In this case, he need not prove. If any of these incidents are there, it is deemed that income escaping assessment. What are the cases? Such cases, 132 is initiated. Then it is deemed that income escapement of assessment, and accordingly, so I need not fall under section explanation 1. Number 2, survey cases. Survey cases, search cases. And money, bullion, jewelry found in somebody's premises belongs to me. Third party information. Part number 3 and 4 with respect to one is tangible, where money, bullion, jewelry found in somebody's premises belongs to me, or any documents which is found in somebody's premises belongs to me. So that is considered as a deemed information which suggests that income escaped assessment. So only in these circumstances they can issue a notice under section 148. So when we get the notice of 148A, B, C, D, so we should understand whether there is an income escapement of assessment. If that is the case, where is the source? Where is the information which suggests income escapement, whether it is the explanation 1 or explanation 2. Next, 148A. Here 148A, so assing officer has to conduct enquiry, providing the opportunity before issue of notice under section 148. This earlier 148A was not there in the earlier up to 2021, but there is a Supreme Court judgment of GK and drive shafts. What they used to say, earlier they used to notice under section 148 to file the return of income first. You file the return of income, then you ask for recorded reason for reopening the assessment. Then they used to give the recorded reason, and then you used to file the objections. Then they have to dispose of that objections. Then they should start with assessment. So now, after filing the return of income, so then you dispose of, then you find that there is no merit in what I am based on opened. So what they have done, so they have coded the DK drive shaft cases into the section itself. Earlier there is no section or no procedure, it is only based on the Supreme Court case they used to do it. Now they have coded the whole GK drive shaft case into section 148A. So that is the genesis of section 148A. So what they are thinking, first give the notice, take the replay. If it is a fit case, then you open. If it is not a fit case, close it at that. Otherwise you filing the return of income, all these things, it is not required to be done. So that is how this 148A has been designed. In 148A, so there are 4 subclasses A, B, C, D. With respect to A, assing officer shall conduct an inquiry if required. They say shall conduct an inquiry if required. How it can be coincide? So it cannot be at the same time you conduct an inquiry if required. So they may say that they may conduct an inquiry if required. That is how they should have phrased it. But they are telling assing officer shall conduct an inquiry if required with respect of information which suggests that income chargeable to tax escaped assessment. So we talked about what is that information. He has to conduct an inquiry and come to the conclusion, yes, there is an income escapement of assessment. Assing officer will issue notice under section 148AA. See, I have this information which suggests that income chargeable to tax is escaped assessment. Request you to give ABCD document. You have filed the return of income, give me sale deed, purchase deed, indexation, how it is calculated, everything he can ask. Based on that, he may say, if they are satisfied, he can drop it at that. If he is not satisfied, then he will go to second stage, 148AB. 148AB is a show cause notice. Show cause notice where he will give, I have an information which suggests that there is a escapement of income. So if you want to say anything, request you to do so. Where he has given an opportunity for you to explain. So where you will be given minimum 7 days, maximum 30 days. He has to give minimum 7 days. If any notice which is less than 7 days, it is not in compliance, the whole proceedings will be quashed. So at the same time you can ask for extension. If he has given only 7 days, you want another 10 days, you can ask. Within 30 days you can ask. He can't deny anything. So but you have to ask. He can't suo moto, he may give, but once you ask, I need 15 days time, he is bound to give. You have to write a letter and they will give. So within not less than 7 days, not exceeding 30 days. It is a show cause notice. I have an information which suggests that there is an income chargeable to taxes escaped assessment. Request you to reply. So once they give that notice, then our case where we need to reply under section 148 EAC. Either you ask for extension or within the extension period you reply it. Then once you reply, he will consider the reply. If he, in response to show cause notice, he will consider 148 EAC. Then he will pass the order under section 148 AD, treating that after obtaining the specified authority approval under section 151, he say whether it is a fit case or not a fit case. If it is a fit case, then it will go further. If it is not a fit case, it will close there. So it has to be very clear, it is a fit case or not a fit case. You have to use that word, it is a fit case or not a fit case. So that is 148A, B, C, D. So once we get it, so let us see whatever the time limits and other things with complications with respect to 148A, B, C, D. Notice under section 148AB issued on December 15, 2023 asking assessee to submit the reply by January 10, 2024. How much days of extension can be sought by the assessee? Next on 5-6 days he can start. So maximum 30 days. Next, here is the catch. What is the time limit to pass the order under section 148AD? There are two circumstances. What if I furnish the reply? What if I am not furnishing the reply? If I furnish the reply, my due date will start from the month in which I have replied, 1 month from the end of the month in which I replied. If I have not furnished the reply, 1 month from the end of the month in which he has given the time. So let us see the time with the practical example how it will make a difference. Here is the case. Notice under section 148AB was given on 27/3/2024. Time limit given to file is 4th April 2024. Now within 7 days anytime you can file. Even on the first day you can file or 7 days you can file. Let us understand assessee files in first case on 30th March 2024. So then the due date to pass the order under section 148AD is 30th April 2024. If he files the reply on 1st April or 3rd April, then the due date will be on 31st May 2024. It is very important based on your clients this thing where every assessing officer thinks that I have given the issue notice under section 148AB. Due date is on 4th April. It is not 4th April for him. He has to see my due date. What is the date on which I have replied is very important. It is not the due date, what he has given is important. Because this will change the whole process of getting the approvals under section 151. We will come to that. So this is very tricky and you should plan. So whether I should file on 4th April or file on 31st March itself. Any questions on this? Okay. Cases where procedure prescribed under section 148 is not required to be followed. Now we have seen 148A, B, C, D. You have to give the show cause notice, conduct an inquiry, consider my submissions, then pass the order under section 148AD, whether it is fit case or not fit case. But in the following circumstances, they need not follow any of this process. They can directly go to section 148. In the case of such cases, or any money, bullion, jewelry found in somebody's premises belongs to me, or any books of accounts, documents found in somebody's premises belongs to me, or any information received through e-verification under section 135A. We were talking about section 135A earlier. So where we will get a 133(6) notice saying that I need the following information. Assuming you are not furnished or what you have furnished it is not satisfactory, they need not follow 148 ABCD. They directly issue 148 notice. So it is very important for us to reply to all 133(6) notice. Otherwise, we will lose the chances of 148 ABCD. So in these 4 cases, they need not follow 148 process. See here, all these things we have seen somewhere. So these 4 items. These are the items which are there under explanation 1 to 147, that is information suggesting income escapement or deemed information is suggesting information. Here is the cases. There are first explanation 1 there are 5 items and in deemed explanation there are 4 items. If I compare what are the things they have excluded 148A process, what are the things they have included into 148 process, here is the list. Explanation 1 to 148 in first 5 they are telling it is information. But with respect to section 135A, so that is fourth point, where they are telling you need not follow 148A BCD. With respect to explanation 2, where deemed escapement of assessment, for three things they are telling you need not follow. With respect to survey, if survey is conducted, then they have to follow section 148A BCD. If it is a search is conducted, then they need not issue 148A notice. If it is a survey is conducted, then they have to issue notice under section 148. It is, if I see this list, it seems to be strange because they are saying second portion is deemed information suggesting, where survey they have removed. With respect to first one explanation, where they say that information suggesting, but they've included 135A. So here is the crisscross provisions are being utilized. So we need to see 148 when they escape, whether it will come under explanation 1 or 2, or it will come under section 148A proviso. Next we'll go to section 148, issue notice where income has escaped assessment. Before making assessment or reassessment, recomputation under section 147 and subject to provisions of 148A, assessing official shall serve, it is not issue the notice, he has to serve the notice on the assessee along with the copy of the order passed if required under section 148A D. 148A D is required and furnish him within 3 months from the end of the month in which such notice is issued, or further time as may be extended. Assessing officer will issue notice under section 148, ask you to file the return of income. What is the time limit he has to give? Earlier it was 1 month. In last year it has been increased to 3 months from the end of the month in which notice under section 148 is given. If it is the 1st March he has given, then he has to give up to 30th June. Even if you give it on 31st March, he has a 30th June. You have to give minimum 3 months from the end of the month. So, and he has to serve the notice at the same time. If 148A is applicable, he has to attach that 148AD order along with 148 notice. Here is the issue. If assessing officer issue notice under section 148, giving a time limit of 1 month to file the return of income, what is the remedy available to the assessee? Yes, now in 2023 when they passed, so we used to get the notices with only 1 month. So what we can do, two things we can do. One is tell the assessing officer and educate him, see now it is 3 months, I will file within 3 months. Or keep quiet if they do anything, and we can always take it a ground saying that you have not given the sufficient time for me to file the return under section 148A. So 148, accordingly the whole proceedings is bad in law. Return of income furnished by assessee beyond the time limit allowed, not deemed to be returned under section 139. Earlier there is no provision, though if I file belated returns, what is the time limit is given, so there was no provision what to do with that. Now they have extended the 3 months and they have told very clearly, if you are not filing the return within 3 months, then your return is not considered as a return filed in response to notice under section 139. What are the consequences if I have not filed the return or filed belatedly within the due date? Assessing will not consider your return filed in response to notice under section 148 while passing the order. Assessing officer will not give you notice under section 143 too because your return is invalid. Number 3, yeah.
Belated return also will not be belated. I mean, belated return 139.5 no.
No, that is not 139.5. So what your 148 is a separate class itself. It is not a belated return. Only I have told you there is a delay in filing the return. It is not a belated return.
Okay, for purpose of 148, if you file, then it will not be forming part of 139 return.
Yes. It is not considered as a return under section 139.
139.
So once it is not under section 139, then as if you have not filed the return at all. So accordingly they will not issue 143(2) notice. Then they will do the assessment under section 144 best judgment and penalty for not filing the return of income, because you have not filed, though there is a delay, so that is not considered the return. Then few complications in 270A penalty. So what you have disclosed, not disclosed, all these things, complications will arise during the penalty proceedings.
In such
So
cases, whether this reductions like ATP are allowed?
section 148. My opinion, if you are entitled, then it has to be allowed. But there is a Sun Engineering case. What it says, section 147 income escapement assessment, it is for the benefit of the income tax department. You can't take any benefit when there is a 148. So it is Supreme Court judgment, Sun Engineering 197 ITR. But I would say you do the assessment or compute as per the income tax. If I am eligible, you give. If I am not eligible, don't give. But you can't say that it is for the benefit of income tax, you can't claim any new deductions. So that is something I don't agree, but department taking a stand that it is a new claim which you have not made in the earlier or you have not filed the return of income, I will not give. But Sun Engineering directly against to the assessing. It is always better to claim in the original return, at the same time file within the due date. Then prerequisite for issue of notice under section 140. Yes sir.
But what use is served there? Is it sufficient if they send a mail for your 140?
See, the mail, whose mail, it is very important. See, there are some cases where the mail ID itself, it is not registered in the income tax portal. Our assessee is not even registered in the income tax portal. They say that I have given the notice in the email. Then it is not considered a valid service of notice.
One of the cases recently, if the mail ID was registered long back, nobody is looking at that mail ID is wrong. So they cannot say that the notice is been served.
See, recently in Karnataka High Court, I was observing some of the cases where judge was taken very lenient view, saying that the earlier CA email ID it has been sent. Though I have already updated in my profile the new email ID, they are supposed to have sent it to new email ID. They have sent it to my old CA email ID. So that's why I could not comply. So they said, okay, if that being the case, we will restore back to the assessing officer at 148A/B stage. Okay, so you go and replay. So if from there onwards, let it take it back. And any number of Karnataka High Court judgments are there. So they are telling it is service means it should be actual service. And I have taken one more stand further. See, service means not at midnight, 12 o'clock. Service means it should be in office hours. Service means what? It will come to my notice. Okay, 31st March at 11:45. If they send the notice, whether it will come to my notice. Service means it should come to my notice. So when it is expected to come to my notice during the service, if they send the mail during the office hours, I can understand. Even though I have not seen, it is considered as served. So that case is still pending. They have served on 11:46 at midnight. So we have filed a case in the Karnataka High Court which is pending, whether it is considered as service or not. Okay. So but there are n number of judgments with respect to service. Still all the judgments are valid. Prerequisite for issue of notice under section 148. The existence of information with the assessing officer which suggests that income chargeable to tax escaped assessment. Explanation 1 or 2, it should be there with him. Then assessing officer has obtained the prior approval specified from the specified authority under section 151. He has to obtain the prior approval, not post facto approval. I will issue notice under section 148, then I will go and approve. No, it will not work. It has to be prior approval. Then assessing officer has complied with the provisions of 148A and passed the order under section 148D of the Act, subject to some exceptions, where we have seen some exceptions where 148A not required to be complied with. These are the prerequisites for issue of notice under section 148. Section 148AB, prior approval for assessment, reassessment, computation of certain cases. This is applicable to the search cases, where central circle cases, if the before passing the assessment order, he has to obtain the approval of JCIT or additional commissioner. He has to take the approval of section 140 explanation. So he has to take the approval and then he has to pass. Earlier we call it as 153B, so now it is 148AB. It is only applicable to search cases or central circle cases. Time limit for issue of notice. See, it is very crucial here. Each word is, it will make a lot of difference, and we have a lot of scope as a chartered accountants. In section 149, so there are 4 things we would like to see. It talks about the time limit. It talks about when you can open 148 and what is the time limit in which you issue the notice. What are the exceptions? 4 things it talks about. We will go one by one. Section 149(1)(a) and 149(1)(b). If it is less than 3 years, then it will fall under section 149(1)(a). If it is more than 3 years and up to 10 years, it will fall under section 149(1)(b). 149(1)(a) is easy. So where if they have income chargeable to tax escaped assessment, so then they can issue the notice. In 149(1)(b), there are other stipulation. He has to satisfy all these things. AO has the possession of the books, other documents, evidence which reveal that income chargeable represented in the form of asset, expenditure in respect of the transaction or transaction relating to an event or occasion, or entry or entries in the books of account which has escaped income amounts to or likely amounts to 50 lakhs or more. First, it should be more than 3 years. If it is more than 3 years, the income which is escaped assessment should be in 3 forms. One is, it should be an asset, it should be an expenditure in respect of transaction or event, or entry or entries in the books of accounts. When they introduced in 2021, they have stopped at asset. In 2022, they have added expenditure as well as entry in the books of accounts. And it should be income likely to exceed 50 lakhs. It should exceed 50 lakhs. If it is more than 3 years, if I show that my income escapement of assessment is 49 lakh 90,000, they should drop it. They are dropping. If you show that my income is not exceeding 50 lakhs, they are dropping. So now is our duty is see to it that how we can bring it down to 50 lakhs. That is number 1. Number 3, whether it will fall under any of this criteria. So now we have seen the time limits and the mode and amount. Yes.
Sir, here the income assessment, I mean for this, no? Say for example, some shareholding has changed and they had a brought forward loss. So because of brought forward loss, so 2 years later, I mean actually they should not brought forward because of shareholding change. By mistake it went 3 years later. It is something like 10 crore or 50 crore, whatever, more than 50 lakhs.
Correct.
In that case, how it will be, sir?
Now you tell me, any of these conditions are satisfied?
My doubt is that. So
No.
it will not be an asset, it will not be an expenditure, it will not be an entry in
Then
the.
it will not come. It will not come. See, all you have to, they have to fit into this 3. If it is more than 3 years, if it is less than 3 years, your logic will not work.
Yes.
If it is more than 3 years, whether it should be an asset or expenditure, in respect of transaction, you should be very clear. I will come to that later. Transaction or relevant event or occasion. And any entry or entries in the books of accounts, you should be very careful with respect to reading this. We will come to that. Each one I have examples. Let us see what best we can do with.
But won't it fall under the entry or entries in the books of accounts, what you said?
No, carry forward losses will not be there in the books of accounts. It is a competition. So where you will add back so many things, you will deduct so many things, and then what you will deduct, it is a business loss, depreciation loss, capital gain. So that will not be there in the books of accounts.
That is not
Even
ideal.
books of accounts, even your returns also will not be considered as books of accounts.
It is not, return is not a income books of accounts. Okay, you need to prove that any of these three, then only it will work. So now the scope is, assessing officer is very less here, very restricted. So they don't want to go and dig it very old unless it is worthy. Then fifth and sixth proviso to section 149. What they say, the time limit for issuing notice under section 148A(b) and taking the replay, and D, this time limit required to be removed for the purpose of calculating 3 years or 10 years. Okay, I will just give an example. I will come to that example. So 148A to D, whatever the time limit they have taken for doing this process, that required to be removed. That is what fifth proviso. At the same time, after removing this time limit, if assessing officer gets less than 7 days, he will get 7 days to pass the order under section 148A(d). So the time limit for issuing a 148A(b)(c)(d), that has to be removed, and after doing all these things, if he gets less than 7 days, the time limit will be extended to 7 days. It is very important, lot of mistakes they will do. So it is fifth proviso and sixth proviso. Already courts have already held that this, if the act says that somebody has to do in a particular manner within the particular time, it has to be done in that manner and that time only. You can't have your own time. So fifth proviso and sixth proviso, it should be very careful. So particularly in the case of 3 years and 10 years, when the time limit is extending up to 31st March, these 3 years. After 1st April it will be 10th year, that is 4th year it will start. So that time you should be very, very careful. Here is the example for the assessment year 17-18, income escaped assessment is 55 lakhs. Notice under section 148A(b) of the Act issued on March 29, 2024. Time to file the replay is on April 22nd, 2024. Okay, assessee filed the replay also April 22nd, 2024. Assessing officer passed the order under section 148A(d) of the Act on April 28, 2024. Fit case, they are telling it is fit case. You can open. Assessing officer issued notice under section 148 on 28th April. Check the validity of notice. Now there are fifth proviso and sixth proviso, and there is a first proviso. So in this case, see whether we are in assessment year 17-18, in assessment year 2023-24, it is 6 years. Earlier proviso, it is only 6 years. Now 6 years has been extended to 10 years. There is a first proviso, what it says, if the time limit in the earlier period is already expired, you can't extend to 10 years. As in today it is expired, 6 years is already expired, then you can't come to 10 years. In this case, so though issued on 29th March 2024, they issued March 29, 2004 within 6 years. As for fifth proviso and sixth proviso, you need to remove the time limit between A and D. That is March 29, 2024 to April 2024, April 22nd, you have to remove. After removing, if he gets less than 7 days, that 7 days you will be granted. That means April 22nd to April 29th he has granted. He has passed on 148, April 28th. This is perfectly valid. See, for the purpose of section 148 notice, we need to see 3 years or 10 year on the date of issue of notice, not 148A notice. We have to see 6 year, 3rd year is over or 10 year is over. We have to see on the date of issue of notice under section 148. 148 when will be issued? After ABCD, followed after ABCD. So it is very critical to see these timelines. Now, all of us are chartered accountants. Now I want to know, anybody don't know the definition of asset? Being a chartered accountant, he is expected to know the definition of asset. Okay. Now income tax is, giving the definition of asset. What is that asset? Immovable property, shares and securities, loans and advances, deposit in bank account. We are talking about section 148(1)(b) where they say that it is represented by an asset. What is that asset? It should be in any of these four category only. If you have cash in hand of 1 crore, more than 3 years, you cannot be issued notice under section 148. It is very important to see that the asset shall include. It is not a inclusive. They should have used includes. They are not yes included. Yes there. They say include means only this. Nothing else. I will leave it to your imagination what are the things it is not included here. Many things are not included. Vehicles is not included. If I say that I have a clinching evidence in my home, I have 1 crore rupees 5 years back, all the document to show that I have 1 crore rupees in cash. If I prove that it was there on that day, so then also they can't do anything. Under section 148 they can't do. So asset means only these four. Now they are in 149 they have already condensed the scope of section 149 by including 3 things. Out of that, asset means only so much, nothing else. Here is the case, assessee purchased 2 buildings for which no source of income is available. The details of are follows. Building A 30 lakhs, building B is 25 lakhs. Year of investment 17-18. Building we can always ascertain when we have purchased or anything. Can the assessing officer issue notice under section 148 for the assessment year 23-24? Sitting as an financial year 23-24. Can he issue?
No.
Whether land, whatever the building, which will come under immovable property,
Yes.
it will come under asset definition,
Yes.
it will come. Still I say we can't issue. Any reason can be found? No, period also it is within the time. So 17, 18, 23, 24 we have a time. See, I will come to section once again. It says represented in the form of an asset. An is one single asset should be more than 50 lakhs. Here in my case is 2 different asset is clubbing together it is more than 50 lakhs. If you see column number 3, 1 minute,
Okay.
I will come to that. See here it says entry or entries in the books of accounts. There with respect to 3 they are telling very clearly multiple entries put together if it is more than 50 lakhs I am okay. With respect to 3, if I see number 1 it says an asset. Here they say that entry or entries in the books of account. They are telling when they want to merge, they have merged and sold, okay, all put together it should be more than 50 lakhs. With respect to asset means it should be each asset exceeding 50 lakhs. At the same time if you see expenditure in respect of a transaction or relation to event or an occasion. Here also they are telling with respect to a transaction. With respect to a transaction, here entries are entries in the books of accounts in the 3. So, my interpretation is each asset should be exceeding 50 lakhs. It is not combined asset, multiple assets. All these things, it has to be tested. So, now it is only 2 years old. So, it is in a different levels. So, it has to be tested. So, take this kind of objections in the earliest possible so that we will get a benefit of all this judgment which will bound to come in another 5-6 years later.
Sir,
Next, yes sir.
Small doubt.
Hmm.
In law there is a expression on that singular includes plural.
But they should have used no. See number 1 and 3.
Huh?
See number 1 and 3. When they have said entry or entries in the books of accounts, why they used entries in the books of account? Entry is enough, no?
Okay.
So I need to interpret. So the way they have worded part number 3 and part number 1. See, I will not say your answer is wrong.
Okay.
So that is how department will argue. Okay. So but make the case.
In books, we record for 2 entries. Building 30 lakhs, building 50 lakhs. 2 entries are there.
No, if it is already recorded in the books of accounts, where is the escapement? In this case, they have not recorded this building in the books of accounts. Okay, so that is represented by an asset. If entry or entries in the record means some false entries, you have booked some bogus expenses. That will come under entries or entries in the books of account. If there is no entries, you can't go into entries. Here is the case. Mr. A spent the following expenses in financial year 17-18. Marriage expenses 30 lakhs, birthday expenses 25 lakhs. The above transactions are not accounted in the books of accounts. Whether asking officer raise, issue, notice under section 148. The logic remains same here also. If you see here expenditure in respect of a transaction or in respect of event or in respect of an occasion, it should be an occasion. Assuming birthday expenses, there will be multiple expenses. If for that expense, that occasion, if it is more than 50 lakhs is okay. If it is a multiple occasions, multiple expenditure, you can't club it. If it is with respect to a transaction, with respect to a relation to any event, marriage or some occasion, it is more of this marriage expenses, all these things they want to cover under B. It is not recorded transaction, it is all unrecorded transactions. With respect to unrecorded transaction will come under 3. First two is unrecorded transaction, third one is recorded transaction. Now, assessee found to be holding a cash of rupees 100 lakhs in financial year 17-18, which is not recorded in the books of accounts. Whether the notice under section 148 can be given for the said assessment year. We saw it is not within the definition of 148 asset, accordingly we can't give. But there is a catch. Assuming I say that I got 1 crore rupees cash, but from 2017-18 onwards I am keeping. That is the explanation we give. But if you see section 68A or something like that, if the person who is holding money, jewelry or bullion, whatever, in the year in which you are found to be owner of that asset is deemed to be the income of that year. They will try to invoke that section 68A, but you have to show something more than that. This is not the year in which I have earned. I have earned that year. I have a clinching evidence. I have sold the property. I got a cash. In the sale deed they have written, with the denomination they have written, saying that this is the denomination I have considered. So then they can't do anything. Okay.
Sir, savings account also will not be formed part of asset. Savings bank.
Balance with bank account. It is there, no?
Deposits, sir.
Deposits in bank account. See, deposit, cash deposit into savings bank account, whether a fixed deposit. According to me, all deposits into cash account, bank account, it is covered. Whether you take it as a loans and advances or purchase of property, whether it is a, so you have to, there is an ample scope for thinking. Then first proviso already told, if the time limit for issuing notice under section 148 is already completed in the earlier, you can't extend to 10 years. Earlier it was only 6 years, now they have extended to 10 years. If it is already expired, you can't take it to 10th year now. So as per the table, see here is the table I have given. Assessment year 14-15, even though there is a within 10 years, notice under section 148 can be given. Notice cannot be given because as on 1st April 2021, it is 6 years is already over. See, here is the table where they say that you can open only for these years. For assessment year 18-19, they could have opened 31/3/2022 within 3 years or 31/3/2025. Anything relating to 17-18 and before, they can't issue notice as on today. 17-18 time limit is over. Assessment year 17-18 time limit as on today is over. So now subsequent period is there. This is the time where if it is less than 3 years, they have to come under 31/3/2022. If I see up to 2022, if it is less than 3 years, then assessment year 21-22. They can, as on today, they can open only assessment year 21-22 and further, not before that. If they want to open before that, they can do so by complying 148(1)(b). Next, section 150, provision in case of assessment pursuant to order of appeal. When there is an appeal or any revision by the courts, then they can reassessment can be made. Section 151, sanction for issue of notice. Sanction, what are the things we require? Sanction is required for conducting inquiry under section 141, 148, 148A. When you want to conduct an inquiry, you need a sanction. Then to pass the order under section 148AD and issue notice under section 148, you need a sanction. So if my case falls under section 149(1)(b), that is 3 years, then who has to issue the sanction? Principal Commissioner has to issue the sanction. If it is more than 3 years, Principal Chief Commissioner or Chief Commissioner has to issue the sanction. We need to be very careful whether our case is falling within 3 years or 10 years. Then who has given? Though Principal Commissioner has given, if the higher authority like Chief Commissioner has given the approval instead of Principal Commissioner, even then it is not valid. The law requires to do in certain manner by the certain person, it has to be done by him only. It cannot be superior or it cannot be by a subordinate. So it is very clear, we need to be clearly know who is given the sanction. Normally in notice under section 148AD, they will write this order is passed with the prior approval of so and so. So it has to be better to know this one who has given the sanction. For the assessment year 21-22, sanction for issue of notice by Principal Chief Commissioner, whether it is valid. Assessment year 21-22, we are sitting in 2025. Principal Chief Commissioner, that means Chief Commissioner is given. It is not valid, it should have been Principal Commissioner should have been issued the sanction. Section 151A. See, now I am going to tell you something. With this, no cases will be lost by the chartered accountants if you follow this. Any case, if you don't have merits also, you take this ground, you will not lose the case. Faithless assessment of income escaping assessment. This section 151A. So where they have section 151A, please read carefully, please follow. Central government can make the scheme for the 4 things. Which are the things? Issuing notice under section 148A, B, C, D, issuing notice under section 148, or issuing sanction under section 151, or order under section 147. These are the 4 things. Central government, they want to eliminate the interface between income tax and assessee. They want to bring some scheme. Thereby, some of the things out of these 4 things, some of the things that can be made as a faithless. This is the scheme, section 151A. Now, they issued notification under section number 18/2022 on 29th March 2022. What it says, out of 4, they have selected 2. Assessment, reassessment, computation under section 147 and issue of notice under section 148. These 2, they are telling it has to be made on automated allocation through risk management strategy only. Which are the things? Issuing notice under section 148 and 147 assessment. So 148A, let the jurisdictional AO will do. At the same time 151 also commissioner, jurisdictional commissioner will give the approval. These 2 things they want to make it under faithless assessment. That is what the circular says. So now, whether the notice under section 148 of the Act issued by the local jurisdictional officer is valid. Because this notification says it has to be automated allocation with the risk management formulated by the board in reference to section 148 for issuance of notice in a faceless manner. They are telling very clearly 148 and 147 has to be done only at faceless manner. This is the notification in pursuance to section 151A. Even today, all the notices under section 148 has been issued by the local jurisdictional officer, which is bad law. The moment 148 goes, all the further proceedings will go. We know in 2022, Ashish Agarwal, so more than 90,000 cases has been treated like income tax. Virtually, Supreme Court has saved. Otherwise, they are supposed to have been thrown out 90,000 cases. Now they are brought in back to save the income tax department. So it is much bigger to that. Around 90,000 cases has been brought back through Ashish Agarwal. This is according to the estimates, around more than 4 lakh notices have been issued and assessments concluded with the demands rising to crores. So, but all the notices under section 148 issued after 1st April 2022 is bad in law. Is it my own interpretation? No. So, already Hyderabad, Telangana High Court is already held and more than 3,000 writ petitions has been disposed of and allowing the writ petitions, and Bombay High Court, it is on 5th May 2024, Bombay High Court also taken the same stand. Bombay High Court also, what we understand from the councils, more than 1,000 cases has been quashed, notices has been quashed. If you don't have merits, just go and say that the notices is issued by that jurisdictional assessing officer, that's all. You will get, in Karnataka High Court, you will get the stay. First you will get the stay. Then, so according to me, once the Bombay High Court, passes the order, then normally in all over India, so they will try to follow Bombay High Court judgment. It is Bombay High Court is considered as authority for taxes and other things. Bombay and Delhi High Courts are most reputed tax benches. So that is what is the position of the law as of today, unless they bring some retrospective amendment.
I was thinking that one is a definitely they will bring it.
Anyways, so we can talk about only law existing as of today. Take this ground once you receive the notice. Actually, if you see, the notification under section notification number 18 per 2022, it talks about only 147 and 148. But Telangana High Court has gone one step further. They told that even 148A also has to be made by the faceless, because who is having the information suggest to your escapement of income? You can't say that I have the information, you issue the notice. It has to be same person. So by interpreting that way, they are telling 148A also has to be done on faceless manner. So I feel that is too much of this thing, but what I am going by simple plain reading of whatever they have given. They have told 4 things it has to be done on faceless. Out of that they have notified 2 things. Out of 2 things, second thing they are not doing it. Even I have gone to one extent, so where 147 faceless is not applicable to the central circle cases. But even then, they have to issue notice under section 148 in faceless manner. Even today, nobody is doing it. So, if you don't have any other option, there is 1 crore rupees cash deposited, all the parameters are fitting, it is a fit case on merits. You don't have a case on merits, take some legal objections like this, it might help you. This is very important. I want any more questions on this. I request you to take a note of Exaware Technologies Limited. There are some very technical things. They have analyzed more than 5-6 technical things. I have not told you because of lack of time here. but it is worth reading this Bombay High Court judgment where they have discussed many things where with respect to 148, 149 and other things. Then 140, 152, where in case of assessment, reassessment, recomputation under section 147, the tax shall be charged at the rate at which charge had the income is not escaped assessment. If it is a business income, it is 30%, you have to tax 30% only. If it is a long-term capital gain, if it is a 20% or 10%, it will be taxed at 10%, 20%. Section 152(2) is very important. It is not normally invoked many times. It is there from earlier provision also. Section 152 is not been amended. I will give you one example. I am a manufacturing unit. I have made an addition of fixed asset 110 crores. I am entitled to additional depreciation, which I have not claimed. I have not claimed in the return of income, and I have not gone to an appeal or anything. Now they want to issue notice under section 148, saying that 50 lakh rupees is income escapement of assessment. That is business. I'll say all the ingredients are satisfied. Then you say, boss, if you want to do it, you do it. You add it. At the same time, give me my additional depreciation. I will make a claim. It says, shall be dropped on showing that he has been assessed on amount as such sum not lower than the amount he would have been rightly liable to, even if the income alleged to have been escape assessment has taken into consideration. You add this, you deduct this, you see my total income. My total income is earlier 100, now it is after doing all these things is 90. As per Sun Engineering, you can't give me any benefit in the assessment. So you drop it, better you drop it. You show this, saying that I have something which I have not claimed, otherwise I rightfully I would have claimed. You show this and you add this and deduct this, then you see what is my total income. The right way of looking at Sun Engineering is, it is not each and every benefit I need to look at it. As long as my total income compared to last time and this time, it is not more or less, then it should be, we are satisfied with the Sun Engineering judgment. One you will take a deduction, one you will take an addition, net to net. Any total income difference is there. If the difference is beneficial to me compared to earlier, then you have to drop it. If it is more than that, let them add it. So this 152(2), it requires kind attention where you will get a lot of things when we will come to know depreciation is not claimed, or in charitable trust. I am entitled to 15% of my income as deduction. I would not have claimed. I will say now I will claim. If you want to add anything, you add. You give me 15% of my total income. You make an application under section 152(2) and claim this. The time limit for completion of assessment or reassessment. No order under section 147 shall be passed after the expiry of 12 months from the end of the month in which notice under section 148 was served. If we serve on 31st March 2024, my time limit will be 31st March 2025. If he serves on 1st April 2024, my due date will be 31st March 2026. 12 months from the end of the month in which notice under section 148 was served. For end of the financial year. End of the financial year in which notice under section 148 was served. Here is the comparison between reassessment in case of such cases and non-such cases. What is the difference? In such cases, 148A to 148D, they need not do. And in the non-such cases, approval for specified authority under section 148B is not required. In such cases is required, in non-such cases it is not required. Otherwise, in such cases, non-such cases, everything remains same. It is very important to note that section 148A to D has been dispensed with. But section 149(1)B is still applicable to such cases. 50 lakhs, asset definition, everything is applicable to such cases. So only 148A to D has been dispensed with. The time limit, everything is applicable to such cases, same thing. Let us see some of the practical issues and other case studies which normally we will encounter. XYZ Cooperative Society obtained a PAN under the category as a trust. Many charitable cooperative societies were taken PAN under trust. After being aware of the error, obtained one more PAN, they have category under AOP and filed the return in the new PAN. So not intimated the bank about the change in the PAN. So earlier PAN what we have given earlier, so that is going on. Assessing officer issued notice under section 148A for not filing the return of income based on the AS information in the old PAN. Now I have a two PAN. This is all cooperative societies. This is a problem. If you put the trust PAN, it will not take ATP. It has to be AOP PAN, then only it will give ATP. So then they applied new PAN, they got the new PAN, but they forgot to intimate banks and other places. Now they have issued the notice under section 148A and B saying that you have not filed the return of income, so much of cash deposits are there, you have interest income and other things. You need to say that whether income has escaped assessment. No, it is already in the new PAN, it is already been given. So whatever the income what you are referring which is already there. If that being the case, assuming if they say that it is a fit case, in 148 notice what return I should file? Because the return is already filed in the new this thing. If this kind of cases, it is the fit case to go to High Court saying that I can't file any return because my return is already filed and assessed, income tax assessments also done, and in some cases appeals also pending.
There is no income escape.
So there is no income escapement of assessment. It is only a technical mistake by not intimating the PAN. Many times you would have intimated but bank has not taken note of. Okay, so this kind of case you might have to give the proper submission saying that this whatever that you are telling is already been taken into consideration in some other PAN. Then Mr. A purchased land for rupees 15 lakhs in assessment year 16-17 and sold in 17-18 for 18 lakhs. The same is offered to tax as long-term capital gain instead of short-term capital gain, thereby is paying only 20% instead of 30%. Can notice under section 148 be issued for such income being assessed at low rate of tax? Whether income escaped assessment? No. But is assessed at low rate of tax. Whether it is possible to open? Income has not escaped assessment. It is earlier also 3 lakhs, now also it is 3 lakhs. But it is assessed at low rate. If you see earlier 148, there is a provision where it says that even if the assessment is already concluded, if they come to know that there is any income which is taxed at low rate or there is a more deduction is given, then they should have given 148. But in the new proviso that has been deleted, that proviso is not there. I would say if something which was there, which is deleted in the new proviso, according to me, they don't want to get into this kind of issues. So, if the income is not escaped assessment, but if it is taxed at lower rate, I feel 148 cannot be done because considering the old provision and the new provision.
In this case, how the department will collect the tax? Remaining balance.
Sir, over. See, if it is more than 50 lakh rupees, after 3 years they say that okay, if it is time limit is over, means it is over. See, this is also they can't open 148, and if they have a time limit under section 263 or something like that, or they can do some search or something like that. If they get any other information along with this, then they have to look at it. Isolated transaction like this, they can't issue. They have to search something else where they can fit into that, and during the course of assessment I found something like this karke, they have to add it. Isolated case they can't do it. Mr. A sold building for a sale consideration of 2 crores for the assessment year 17-18 and the same considered as a full value of consideration while computing the capital gain. He has sold it at 2 crore rupees. He has received 2 crores. value adopted for stamp duty purpose in terms of section 50C is 7 crores. Can notice under section 148 be given for this case? It is 50C case. Is purely 50C case or 43CA case? It is more than 3 years. It is more than 3 years. Now I need to go to more than 50 lakhs. Yes, more than 50 lakhs. 2 crores, 7 crores. Now the 3 conditions: whether asset or expenditure or transaction recorded in the books of accounts. Now transaction, it is a deeming provision. 50C, it will never record in the books of accounts. It is not an expenditure. Whether that is an asset, whether that is an asset,
There is no asset.
50C is only deeming provision. Says that your sale consideration instead of 2 crores you replace with 7 crores. But they never say that you have taken in cash, that's why I am increasing 7 crores. It is not like that. It is not like section 68. So it is only deemed that you have received that 7 crores and you have to pay. So asset means what? That income escaping assessment should be in the form of asset. I have not received the asset. In this case, in 50C case, more than 3 years, you can't issue notice. They have issued the notice in one of our cases. Karnataka High Court has given the stay on this matter. So, for 50C case or for 43CA case, you can't say that income chargeable tax escape assessment more than 3 years. If it is less than 3 years, then we have no
The
options.
6 years logic also gone, sir, no?
Which one?
6 years. 2017-18, 6 years time limit also done.
Yes, assessment years, that 6 years, okay. I am assuming that that 6 year time is there.
No.
Okay. Search in the premises of Mr. A took place on 16/12/2023. Can a single officer issue notice under section 148 for all 10 preceding years, or compliance of 149(1)(b) is required or not? Now 16/12/2023 search has taken place. When he has to issue the notice, we have already seen the table here where how much back somebody can go.
Only up to 89.
So they can go maximum 6 years. Because in 2023, I am sitting as a more than 10 years, I can go in 2000 assessment year. If I am sitting on 23-24 financial year, I can go assessment year 17-18 maximum. I can't go before that. So to get the 10 years time limit, they have to wait up to 2030-31 so that they can open in 2021-22 onwards. Search on the premises of Mr. A took place on 16/12/2023. A single officer issued the notice for the following like this. He has issued 23/24, 143(2), he is issued 22/23 and 21/22, he is issued 148. Since it is a such case, whether he can issue 143(2) notice, he should have issued 148 notice. Can we take that stand? It is such case. So it is a deemed information. So explanation 2. Then they need not fall under section 148 ABCD. So what the understanding our courts have held, when there is a time limit for issuing notice under section 143(2), you can't jump and issue 148. 143(2) is a wider application where you can issue without any reason. In 148 there should be, you have information which suggests that there is a income escapement of assessment. So what they say, if the time limit to issue notice under section 143(2) is not expired, you have to issue 143(2). If somebody has issued 148, it is bad in law. So thereby whole process is bad in law. Assessee, while filing the return in response to notice under section 148 of the Act, has made some errors. Can he file the return filed in response to notice 148 can be revised? What is the remedy available to the assessee? He has made some mistake in 148. Can you revise the return in filed in response to 148? Revised return is possible for 148 return. Section is silent, so virtually it is not possible. It has to be we have to be very careful while filing the notice under section return to in response to 148, because you can't revise. In normal scenario you can revise as many, even belated returns also now you can revise. This cannot be revised. Mr. X purchased property for 80 lakhs in assessment year 18-19, sold the same for 1 crore 1 lakhs, that is 1 crore 10 lakhs. Assessing officer issued notice under section 148A(b) stating that assessee has not filed the return of income for the assessment year 19-20 and income escaping assessment is 1 crore 10 lakhs. Is it valid? 149(1)(b) is applicable. Now he is telling, see, now you have not filed the return of income. They have the information from the risk management strategy. You have sold one property for 1 crore 10 lakh rupees. Now it is more than 50 lakh rupees. It is considered as an asset, and accordingly I want to issue notice under section 148. What we have to do? See, it is not income chargeable to tax is important. It is not an income. Income means it is not a gross income after giving the deduction first cost of acquisition or index cost of acquisition. If that income exceeds 50 lakhs, only that you require to be considered 50 lakhs. It is not only gross sales. It is not only gross sales, even for business associates where they have deposited crores of rupees cash, where his profit is 4% or 5%. If you show that this whole cash deposit is out of my business and my profit is less than 50 lakh rupees, they can't open. So this is Karnataka High Court is upheld in the case of Sanat Kumar Murli versus ITO Ward 433, where they very clearly categorically says that it is income chargeable to tax. Even under section 149(1)(b) they use the word meaning income chargeable to tax. Income chargeable to tax is not a gross income, it is a net income after allowing all the deductions. Defenses are available to the assessee. We have seen so many defenses. Anything is left out, let us see. Jurisdiction of the assessing officer. Monetary limit. It is very important for small assessees, where if you see there is a monetary limit, there is a notification. Up to some level it is with ITO, after some time it will be ACIT. If the suppose notice under section 148 supposed to have given by the ITO, if the given by the ACIT, vice versa, so then the notice is invalid. So for the checking of this, there is a notification, you can take a note of this, where up to 30 lakh rupees in metro station it is ITO, and AC and DC is more than 30 lakh rupees. Now though they are opening for assessment year 19-20, they have to look into the income of the previous return what I have filed. It is not on that year. The jurisdiction depends on the previous income tax return. Last year I filed with 10 lakh rupees, it was ITO. This year I filed with 40 lakh rupees. Then it has to come to DC and DC has to issue the notice, not ITO. The PAN transfer has to happen based on the previous ITR. What is the previous ITR? Or which is the last return available to the assessing officer. Last 2 years I have not filed, then it will go back to the old thing. Then that is the jurisdiction. Take the ground on jurisdiction.
All the companies having losses will go to IT only.
More losses that less than 30 lakhs. Income or losses less than 30 lakhs. Income 30 lakhs, losses less than 30 lakhs, it will come to IT.
Income or losses?
Yes, yes. Okay. This is the notification. Based on that, you can take an objection. And many times, somebody from Calcutta, they have already relocated here and changed their PAN address, everything. But the notices will come from Delhi, Calcutta, and other things. You take a stand saying that assessing officer means assessing officer having the jurisdiction. It is not any income tax officer. So my jurisdiction is in Bangalore. Assessing officer who is having in Delhi, he don't have a jurisdiction. So the notice issued under section 148 is bad in law. So you can take it on two things. One is on monetary limit based on the assessing officer or territorial jurisdiction.
So nowadays all are the e-assessment.
That will come under after 148 onwards. That is completing 142 and other things. What about issue of notice under section 140A, 148A, B, C, D, 148? At any point of time, if assessing officer is not the correct officer, then the whole proceedings is bad in law. All these jurisdictional things you have to take at the earliest opportunity. Tomorrow, you take it, whatever the reason, if they consider or not consider, we will see. If the assessment comes in our favor, then we will not question. If something it is not in our favor, then all these things it will be an issue. Raise a question on risk management strategy. I have already told what is that CBDT circular with respect to risk management strategy. To the best of my knowledge, I have not seen. Say that, request you to give the risk management strategy what you are relying on. In 148A, we reply when you are giving all these things you ask, whatever the worth it is. Then factual submission with complete documents. We are talking about cooperative society with the 2 PAN. When we say that this income is already suffered tax in the other PAN, we have to give the proper documentation to prove that all these things have been given. So tomorrow I can't say that I have not furnished there, so I will complete the assessment. So then it will be a problem for us. Even with respect to sale of immovable property, they will say 1 crore 10 lakh rupees. Unless I give the cost of acquisition, how they will come to know? So it is better to give all factual submission and seek the opportunity of being heard through person. Go and explain to the assessing officer, this is what the case, less than 50 lakhs. Yes, there is a escapement, it is less than 50 lakhs, you need to drop the case. Reply relating to asset expenses book entry, it is very important. In most of the cases you can escape through asset expenses book entry. Proviso to section 149 compliance. What are the dates you have to exclude, what are the dates you can include, whether it is increased to 10 years, 6 years. Already assessment is over. See, I didn't tell you one more thing. Earlier, if the assessment is already completed, they will get only 4 years time to open the assessment, not 6 years. Unless they prove that because of my fault, they could not see that time. So now that time is only 4 years. It is not 6 years. Even not even 6 years. It is only 4 years they can open. Okay. So all these defenses is available to the assessing. Mr. A staying in Davangere and issued the assessed to income tax by ITO Ward 1 Davangere. He moved to Bangalore financial year 22-23, updated the Bangalore address in PAN. Mr. A also filed the return of income with the new address. ITO from Davangere issued notice under section 148 AB. Now, what you can do, you already done it. So now the person who is issuing the notice, he don't have jurisdiction. Even though 148 AD from B to D, if they transfer to the local officer and issue, even then it is bad in law, because the starting point is very important. If starting point is illegal, further proceedings everything becomes illegal. Then what they have to do? Drop that, issue 148 AB by the right jurisdictional assessing officer. See, these are the steps what assessing officer and we have to follow. Assessing officer should have information. We suggest that there is a income chargeable to tax escaped assessment. Then he has to analyze section 149 1A or 1B 3 years, more than 3 years, asset expenditure, entry in the books of accounts. Then he has to obtain the prior approval for issuing 148 AA or AD or issuing 148 notice. Assessing officer conduct an inquiry before issuing the notice. Then assessing officer provide an opportunity of being heard to all the people. Then he has to pass the order. Either you consider as a fit case or not fit case. Then it has to be in writing. He has to consider all your submission and he has to pass the order. Then if it is a fit case, then he will issue 148 notice. From 148 notice, within 3 months you have to file the return. Then they will issue notice under section 142(1). Then they will issue show cause notice. Then you replay. Then finally they will pass the order under section 147. within the time limit under section 153(2) within the time limit. So that is 12 months from the end of the financial year in which 148 notice was served. So these are the steps assessing officer has to follow. Almost 11 steps, but in the each steps there will be multiple things. So 148 as a chartered accountants, sky is the limit to think and do the replay. So according to me, so they should have much more careful. The definition of asset, why it is required? Asset means asset. So by giving something, so you are excluding other things. And you say an asset, then entries are entries in the books of accounts. And you say that 148 notice has to be given by the faceless and local officers are giving. I feel many times it is bad for the country. Like so many junior cases where they have to pay the taxes, they have got escaped. So maybe we are also one of the culprits. So anyway, so I will give consultation to my case, but as a country, it is not good unless they plug all these loopholes. This is what is my presentation. I am glad to answer any of the questions relating to the topic, anything which related to 147 to 153. Either I have conveyed or confused people. It's something which So, but it is very interesting as they're learning as a students of income tax. So each day, and when we got an opportunity to do some extra research with so many queries. So we should be at least to that extent we should be thankful to our clients for creating such a mess. Okay. So any questions? I am happy to take it. Yes, sir. Yes, sir.
There was one JDA transaction in assessment year 2013 and 14. The JDA was completed after 10 years in 22-23. Now the flats are being sold in assessment year 24-25.
22-23 is completed. No, assessment year 22-23. No. Then.
Now the flats are being sold.
Okay.
Now the JDA tax earlier, which was supposed to be paid, was not paid. Can we take a shelter under this 10 years or 6 years saying?
You can take, but there is one Supreme Court judgment recently, which is that judgment. So I will tell you that judgment. What it says. In normally JDA, they say that very clearly. This is JDA is only permissive possession given to the developer. This is not considered as a transfer under section 247 of the Act. It will be considered as a transfer only on completion of JDA. If they have written that, then the payment of tax, which will move from 2012-13 to 22-23. If the JDA says on that day it is considered as a transfer, then you can take that shot. There is a Supreme Court judgment, so it is very clearly on this. And even section 145(5)(a), so which is introduced in 2018-19 or something like that. 45(5)(a). So there, if an individual or HUF enter into joint development agreement, and anything what you get it only after completion. That instrument should be registered. If you comply with section 45(5)(a), then it will move. If assuming you are a partnership firm, enter into joint development agreement and say that on the day of joint development agreement itself it is a transfer, then you can escape.
The JDA was registered.
But 45(5)(a) is introduced now.
No.
So in 2012-13 it was not there.
Not
there you have to go through income tax, Supreme Court case law.
They had a case.
Balbir Singh saying it. And one more is there. Sheshasai paper mills case, Supreme Court. So that will come to your rescue, where they have clearly told if you have written this paragraph in your JDA, normally it will be there in all JDAs, then it will be moved to the date of completion, not on the date of handing over. Yes?
Only this faceless assessment is for adjudication only. For this scrutiny cases and all this search cases and all, it is manual only, no?
Yes, there are two things. One is search cases and international taxation cases. It is manual. So other than that too, everything is faceless. But my reading is 148 has to be given faceless. Then you do manual scrutiny. Because the notification for manual scrutiny does not include 148. Then I need to go through 151 year. Any other questions? See, all these things what we have discussed is only purely technical, no facts. So apart from facts, you have so many defenses are available. So according to me, after 2021, after introduction of these sections, the notices under section 148 is increased by manifolds. Earlier 148 notice 1 or 2 in a year, if I see, it will be more. So now more than 143 notices, now we are getting 148 notices.
Because of AIS, sir.
Because of risk management strategy. So you would have searched somewhere else. They will just upload, okay, these are the PAN, so I have information, it will come to the respective officers, based on that they will open the assessment. I hope I have able to convey to what extent it was given to me. I thank Bangalore branch of SIRC FICI for giving an opportunity to present my views on section 147 to 153A, and also thank Mr. D.R. Venkatesh. Now he is no more, he is my guru. He was from last 20 years I was working with him, but for him I would not have been here today. And my all family members and my colleague Mr. Rohit, he has helped me a lot in preparing this kind of presentations. I thank you one and all for patient listening. Thank you very much.
Thank you, sir. That was a knowledge enriching session, I believe. On behalf of the Bangalore branch of ICI, I would like to present a memento to sir. Thank you, Manoj. I hope everybody has registered for the startup sphere. If not, please to register. There is an offer going on for 5 members. As a group, if you register, still it is 5,000 rupees.
Welcome members. I request our speaker Kinjal Bhutta to come forward to the dais. It's my privilege to introduce the speaker of the session. Kinjal Bhutta is having working experience of 15 years in the field of direct and international tax. She has practiced as a chartered accountant and now practices as an advocate, specializing in the field of direct and international tax. She represents before High Court, ITAT, DRP, CIT appeals and various other authorities. She has authored 2 publications, one on practical guide to faceless assessments and appeals, and other one, presumptive taxation under section 44 AD, ADA, AE and by BCAS. She is an Honorable Joint Secretary of Bombay Chartered Accountants Society. She is a co-operative member of Research and Exposure Draft Committee of WIRC of ICAI. She contributes various articles to tax journals like Chambers of Tax Consultants, AIFTP, BCAS, and writes a monthly feature of ITAT decisions in Chambers Journal. She is a seasoned speaker at various platforms of professional importance. She also addresses various colleges like Nalsar, Mithibai College, SVKM Group as a guest lecturer on topics of direct international taxes. Editor of BCAS references since 10 years, annual flagship publication of BCAS and contributor to annual budget publications. She has been awarded with Rising Star Award 2022 in the APEC region for category of tax dispute resolution by International Tax Review. With this brief introduction, I hand over the session to the speaker. Welcome.
Thank you so much for the introduction, and a very good evening to everyone. I first of all thanks to Siliguri branch of ICI Bangalore branch. I'm so sorry. Actually, I was last week before the Siliguri branch. So, thank you for the Bangalore branch of ICI for calling me for this workshop. I think I have been addressing this workshop since last 3 years, but I had the fortune to come physically here. I think the last 2 times it was in a hybrid model, so I used to deliver it online. I come and hail from Mumbai, so I am really glad to come here and have a physical session with all of you. The topic which is being given to me is around faceless assessments and appeals. I think the most vibrant administrative feature which has been brought by the government since 2020. So I have been given a difficult task to finish that within 2 hours. The first thing which I told them is that each of the provisions like faceless assessments as well as appeals require 2 hours each. Considering the kind of complications, considering the kind of controversies which have gathered around the scene, we have, I think, lakhs of writ petitions which have been filed across India regarding these 2 provisions. So definitely it's quite a vibrant or a dynamic topic right now when it comes to the administrative functions of income tax authorities. So today, since as I mentioned that we have just 2 hours and I have lots to cover, so what I have decided is that rather than making the entire session about only discussing issues, lot of issues these days under faceless assessments and appeals are more or less basketed into certain categories. So most of the controversies which are there on this topic, I have tried to consolidate a lot of High Court decisions. I have excluded myself to give any ITAT decisions because that will be very customized and specific. So I have tried to give almost all or more of them the Supreme Court and High Court decisions, dividing it between the controversies which are right now, the most prominent controversies which are there, which could be a good read-sake and a material to use. But most importantly, I thought I will take this opportunity to rather go back to the provisions and probably do a threadbare analysis of the sections of faceless assessments and appeals. Because most of the times, whenever there is a controversy coming up or wherever there is a practical difficulty or legal issue, most of us are guilty of going to the decisions, trying to find out the decisions and using those decisions for our submissions or before the appellate authorities. So the idea was, since the course itself mentions revisiting income tax, I thought that probably we will revisit the entire section since it's a very huge section, and then probably once we take an hour or so discussing the legislative provisions under that, then probably we shall get into the controversies and other parts of the faceless assessments and appeals. So yeah, I have already mentioned what will be the contents today. Starting with the a very brief background about faceless assessments. I think we all know that it has been it was introduced during the peak COVID period in 2020 and by a very historic and a heroic kind of speech by our Prime Minister Mr. Modi, and wherein he had introduced three things together: faceless assessments, faceless appeals and taxpayers charter. These were the three things which he had brought about together in August 2020. And all of the sections, all of the appeal provisions and the schemes, they were either brought about by way of TOLA, which is the Taxation Ordinance Law Amendment Act, or by way of bringing circulars, notifications, instructions, orders. So these were the various means and ways in which it was incorporated into the law system. However, when it comes to faceless assessments, the history drives back in 2015. So it started as a pilot project in 2015, wherein it was implemented only in certain 4 metro cities. And in those 4 metro cities also it was done on a sample basis. So it started just like an experimental way of functioning, because India never had any e-proceedings. So it started e-proceedings wherein everything between the assessee and the department was through email based system. At that time we did not have the ITD portal, the income tax portal which we have right now, designated portal for each assessee. At that time it was not formulated. That got formulated way back late in somewhere in 2017 or 18. So initially they started, and I think they started getting success in the email based proceedings. They continued to do it from 4 cities to 8 cities, and then probably till 2019. In 2019, there was a landmark scheme which came into, which was e-proceeding, e-assessment schemes, which came before faceless assessment. And that was the scheme which brought about ITBA, which is the Income Tax Business Application, which we now call as the ITBA portal, or the specific portal of assessees, where we make the submissions, where we can browse the notices which have been issued, and we have all other compliances. The orders are being uploaded there. So every assessee has a specific user ID and a password, and then there are a lot of fields wherein you can get the details of all your assessment proceedings. So that came up with e-proceedings, and in 2020 later on it converted itself from e-proceedings to faceless assessment proceedings. Now, what was the difference between the two proceedings is that under e-proceedings, it was through the income tax portal, it was through email based, however, it was with our own jurisdictional assessing officer. So that was the major difference between the e-assessment and the faceless assessment scheme, whereas faceless assessment scheme, the assessing officer was not known to the assessee. So for example, if I am from Bangalore, then earlier I would have a jurisdictional officer who is based in Bangalore based on my official and registered address of premises or work premises. Now after faceless assessment, I may be stationed in Bangalore, but my assessment could be done with an officer who is in Mumbai, or an officer who is in Kolkata, or an officer who is in any other city. So that is the the reason and the entire thought process behind the faceless assessment proceedings, that you would not know the officer. Obviously, when it comes to faceless, it is going to be faceless one way. So basically, I am an assessee, I don't know the officer, but when it comes to the officer obviously knows me, because my details, my PAN card, my registered address, everything is there with the assessing officer. So my assessing officer will very well know me, but my assessing officer will not have any access to contact me. So the entire idea of faceless assessments was based on 3 major principles. One is bringing efficiency in the entire administrative processes. Second is bringing transparency. So we all know that there were a lot of issues when it came to physical dealing of assessment proceedings and physical dealing of appeal proceedings. The entire reason of bringing the faceless procedure was to reduce corruption. So that was the major agenda, and obviously at the same time to standardize the entire process, because earlier it used to be quite customized. Every assessing officer will ask its own set of details. Every appellate authority will be conducting assessments on its own. So suppose there is an issue of deemed dividend under section 222E, you will have one officer with a similar facts, making an addition. You will have another officer giving me a relief. You will be having another officer who is giving part relief. That is not a standardization when it comes to income tax proceedings. And when there is no standardization, obviously it will lead to controversies, because the person who has not got relief will use the decision of the assessee who has got a relief, and that is how non-standardization brings and multiplies into a lot of controversies and litigation. The idea was to consolidate, to have a similar understanding, and also to train the officers, the assessing officers, the appellate authority officers, make standard operating procedures, make them follow one SOP, and so that the entire proceeding is more or less similar, whether it is in the western zone or whether it is in the northern zone of the country, the proceedings has to be constant. That was the entire vision when the faceless assessments came into picture. Earlier, as I mentioned, we had e-assessments. Later on, when the Taxation Ordinance Amendment Act came into picture, Section 144B, which is the section of faceless assessments, that section got introduced into the Income Tax Act, and the section brought lots of controversies with respect to faceless assessments. So within 2 years of bringing the section, we had thousands of writ petitions which were pending, and one of the most important reason was subsection 9 of section 144B. Now, subsection 9 was surprisingly a very friendly section for the assessee. The section simply, in a simple words, the section was mentioning that if any particular thing or if any assessment proceedings are not done in accordance with the section 144B, so there was subsection 1 to 8 which laid down the entire procedure of how faceless assessment has to be done, like right from issuance of notice to signing it digitally to making a response to referring it to the other units of assessments. It laid down an entire exhaustive procedure. Subsection 9 tied up the hands of the income tax authorities and making it deterrent for the revenue by saying that if the income tax officer is not abiding by the procedure which is being given under subsection 1 to 8, then the entire assessment order shall be considered as non-est, which means that it will nullify. So it had such a wide power, a very surprisingly but favorable kind of provision under the Income Tax Act. We have never seen such kind of provision under the Income Tax Act before, wherein because of any procedural defect, the entire assessment order and proceedings were considered as nullified. Because of this one and only one provision, there were multiple writ petitions which were filed before the High Court, especially during that COVID period of 2020 to 2022. And that is when there was this major amendment which came up in the by way of Finance Act 22, wherein they resubstituted the entire section. So within 2 years of bringing faceless assessments, they resubstituted the entire section. Now, why this history is relevant? This history is relevant because the substituted provisions are applicable with effect from 1st April 2022, because that is where the Finance Act has introduced these provisions. So all those assessments which were concluded in between the period of August 2020 to February 22, these will continue to be catered under the older section, the earlier erstwhile section of 144B. All those assessments which have been taken up or concluded after 1st April 22, for those the new section provisions will be applicable. And there is a lot of difference when it comes to the administrative functions between the old section and the new section. But today I will be discussing the new section itself. But one of the major change I have already discussed, which was taking away or deleting the subsection 9, which was a favorable position. They deleted that particular provision from the new sections. Coming to the background of faceless appeals. So faceless appeals was quite new. It never had precedence, but they directly started faceless appeals in 2020. After assessments and appeals both were introduced together. The only flavor of getting an electronic version of appeals was somewhere introduced in 2016, where we transited from filing appeals physical to filing appeals electronic. So all those returns which were filed electronic on the income tax portal, all those returns, the appeals had to be filed electronic. So there are very few exceptions when it comes to filing returns physically. I think these days we have hardly 1 or 2 exceptions. Apart from that, all the returns have to be filed and processed electronically. So that means that every appeal which you file before the CIT appeal has to be an electronic appeal. It has to be going through the portal. There is Form 35 which was refurbished. The new form was introduced with lot of new features which we are not covering today because that is into the procedural aspect of filing up of forms, but it came up for the first time in 2016, and later on directly in 2020 the faceless appeals scheme was introduced for the first time. In September 2020 the faceless appeal scheme was introduced with immediate effect. Now, one of the major differences between faceless assessment and faceless appeals, apart from the authority, obviously assessments is assessing authority and appeals is the CIT appeal authority. Apart from that, one of the major differences when it comes to drafting of law is that faceless assessments was brought by way of a section into the Income Tax Act, wherein section 144B was introduced, which postulated the entire procedure. But when it comes to faceless appeal, there was only 2 to 3 subsections which were introduced to an existing section of 250. There is a section 250 is the procedure before the appellate authorities. That procedure, they introduced section 6A to 6D, wherein they empowered the central government to introduce such faceless appeal scheme. So the entire faceless appeal scheme as of now is also by way of a circular. It is nowhere in the Income Tax Act. It just has the enabling provisions in the section. However, the procedure is not a part of the Income Tax Act. That is by part of the circular. We all know that circulars are delegated legislation. They are not the main legislations. The main legislations are our Income Tax Act and our income tax rules. Circulars are binding on the income tax authorities but not on the appellate authorities. Circulars are not binding to the CIT appeal authorities. Circulars are not binding to appellate authorities like ITAP and High Court, Supreme Court. So that is a major difference. When a section is codified into the Act, it has a lot of more legal sanctity as compared to an appeal provision which has been brought about merely by way of a circular. And there has been lot of litigation around this. In fact, the constitutional validity of faceless appeals is under challenge before the Delhi High Court. We have still not received any resolution, or we have not received any order for that as such. The main reason of arguing based on the constitutional validity is that itself, that the entire procedure so essential has been kept outside the Income Tax Act and brought by way of circulars. Another deterrent of having such extensive procedures through a circular is that it has the power to be amended very frequently. When it comes to Income Tax Act, it gets amended only when a Finance Act is passed. But when it comes to circulars and notifications, a circular can come up today on 21st, and on 25th they can override the earlier circular. So it's very easier to amend those laws, and that is also one of the major difference between a provision coming in through the Act and coming through way of a circular. So another important thing which we need to know under faceless appeals, which is quite recent, is the e-appeal scheme. So since the faceless appeal scheme has been introduced and made live, practically speaking and from our experiences which we are facing, the faceless assessments procedure, since it had started like e-assessment procedures, people did have an experience and it floated around very nicely. People took it nicely. We have now started getting some kind of reasonable orders when it comes to faceless assessments. However, there are a lot of confusions, controversies, but more or less we can say that procedurally it is settled. The assessing officers have been technologically adapted and they are now understanding how the submissions are to be uploaded, how the notices have to be uploaded. But when it comes to faceless appeal, it has been a completely different situation. We have almost, as on January 2024, there was a RTI application which was filed by AIFTP to the Ministry of Law asking for details about how many appeals are pending. So the data which we had got is that around 4.5 lakhs to 5 lakhs appeals are pending before the CIT appeal alone. Whereas if you compare that with the appeal proceedings which are pending before the ITAT, they are almost 10%, which is around 40,000 to 50,000. So the situation as of now is that, suppose I'll give an example of how things are working before the Mumbai ITAT. If we are filing an appeal before Mumbai ITAT in February, we are getting a hearing in June. We are getting hearing in 3 months. We are getting a disposal in 15 days. That is how fast the ITAT is working, for the only reason is that they don't have pendency. They don't have dearth of appeals, and the main reason for that is the entire 4.5 lakhs to 5 lakhs CIT appeals are stuck before the faceless CIT appeals. Now the reasons apparently which has been brought about, because there were a lot of representations which have been made by or a lot of CA bodies, ICI has made representation, there are a lot of other industry bodies which have made representation. The major reason which have been cited by them is that it has been difficult to adopt the technology by the Commissioner of Income Tax Appeals. Most of the CIT appeals which we have are ranging from the age of 50 to 60, and it has been difficult for them to adapt to the technology. That is the reason which has been given. Also, when it comes to CIT appeals, what happens is that there are no SOPs which are made. The SOPs are made only for faceless assessments. But when it comes to CIT appeal, there are no SOPs which have been made, and they are left on their own on how the entire appellate procedure has to be done. So these are the few reasons why it is being stuck. But we have matters which were there before the assessing, before the physical scenario. We had before the CIT appeal physically. We've argued those matters, no order was given, those matters transitioned to faceless appeal. And under faceless appeal, we are waiting since last 4 to 5 years for getting orders. So submissions are going, notices are being received, but there is no disposal. Disposal is stuck, and that is the reason why there was an introduction of e-appeal scheme in 2023. That came up by way of an announcement in the Finance Bill 23, by way of Finance Act 23, wherein a parallel jurisdiction of Joint Commissioner of Income Tax Appeals was introduced into the Income Tax Act. Section 246 was amended and a specific provision was brought into, and Joint Commissioner of Income Tax Appeals were given the power to distribute certain of workload from the faceless Commissioner of Income Tax Appeals. Now what is that entire scheme, we'll definitely go through in detail, but that is the latest amendment into this faceless appeal scenario. Now coming to the relevant legislative provisions. So as I mentioned earlier, and for the benefit of all who joined later on, what we'll do is we will first in the today's session discuss the legal provisions. We try to do a threadbare analysis of the section of reading, because the section is quite extant and it has wider provisions, and then probably once we've learned through and revisited our basics, we'll go on to the issues and the practical difficulties. So yes, so one of the most important things is mentioned in subsection 1 of section 144B. This is the new section. This is the substituted section with effect from 1st April 2022. As I mentioned earlier, there was another section which had different subsections. There are a lot of differences between the two sections. I am covering the latest provisions in this particular analysis. The powers given under faceless assessments are notwithstanding to any other provisions in the Income Tax Act. Now when we have lots of provisions in Income Tax Act which has notwithstanding powers, but when it comes to procedural sections, section 144B is not a charging provision. When we suppose for example we say 44 AD, which is a presumptive section, there also we have notwithstanding provisions, or we see 43D, there also we have notwithstanding provisions, but those are all charging provisions. When it comes to procedural provisions, this is one of its kind which has made notwithstanding, and one of the reason of this thought process would have been that there are lots of other sections in the Income Tax Act which are related to the assessment proceedings. For example, section 143(1), which is summary assessments, that is also related to assessments. Whether it is section 142(1), which is a section for issuing notices by way of a questionnaire. So there are lots of provisions. Section 147, which is the reassessment provisions. All of these provisions are connected to the regular assessment provisions. Earlier, the regular assessment proceedings were covered by section 143(3). Now they are covered by section 144(b). So now when we are receiving the orders, though section 143(3) continues to be into the Act, and one of the most important reason why it continues to be in the Act is twofold. One is that there are certain exceptions to faceless assessments. So in case of international tax cases, it is exempted from faceless assessments. In case of non-resident individuals, faceless assessments is not applicable. In case of tax evasion cases, again faceless assessments is not applicable. So there are 3 to 4 exceptions under the faceless assessment scheme. They all will continue to be considered under the regular assessment proceedings under section 143(3). So that is why 143(3) is still there. Another reason is that 143(3) was the original provision which enabled to bring a new provision for faceless. So if we see subsection 3B and 3C of 143(3), that is the section which is an enabling provision to bring this new section into the picture, and that is why we have 2 parallel sections right now. Why I am discussing all of this is because there are, as of now, if one opens the Income Tax Act, there are so many provisions and so many sections which are used for income tax assessment that one may get confused that which is the jurisdictional section and which is the procedural section. So now when we receive the orders, we normally read the orders as order under section 143(3) read with section 144(b), which means it is a regular assessment which is done along with faceless provisions. There could be another order if it is a 147 or a reopening provision, then it will be 147 read with section 144(b), means that there is a reassessment which has been done but procedure are done as per faceless. So it's a notwithstanding provision. Another important element is that now section 144(b) also covers reassessment. So the earlier section which came up in 2020 had only assessments and recomputation. It had excluded reassessment from its scope. Now with effect from 1st April 22, even reassessments are covered, and that is the reason you would have observed that when it comes to 147 assessments, what is obviously entire reopening provisions have also changed, and I think when I saw the program structure, that session has already been taken. So you must be aware about the entire new provisions under section 148A. So now what is happening is there are two authorities which are functioning together. Simultaneously they are functioning when it comes to reassessment proceedings in 2 stages. One stage is issuance of notice under section 148 capital A, wherein you are given a show cause notice from the jurisdictional assessing officer, wherein you are supposed to make a reply under subclause B of section 148A capital A. Then there will be a disposal order which will be made again by a jurisdictional assessing officer, and the jurisdictional assessing officer along with that will issue you a notice under section 148. That notice under the new section means that your reassessment has been initiated. After issuance of notice, the file gets transferred to faceless assessments. So all the other procedure after section 148 notice has to be done before the faceless authority. So once a notice under 148 is been issued, an assessee has to file a return. that return is filed on the income tax portal, and once you file your income tax return, the first notice which you receive, whether it is under 143(2) or whether it is under section 142(1), both of these notices will be issued to you by the National Faceless Assessment Center and not by a jurisdictional assessing officer. And the reason behind the same is the amendment which is made in this section, wherein they say that they are also covering section 147. Now, since we are discussing this issue here, though I have taken up in the controversies, this has been a major legal controversial issue right now. Across all the high courts, we have one favorable order from Bombay High Court in case of Hexaware Technologies. That order has been recently passed last 1 month back. Now, what is the controversy here? The controversy is very simple. Can, in reassessment proceedings, the assessing officer who is giving a notice and disposing of my objections be a different person, and the person who is making the final order be a different person? We had this issue, if many of you would have functioned under the earlier 147 law, we already had that issue that the person who is recording the reasons, earlier we had the language of reason recording. So person who is recording the reasons cannot be different from a person who is passing the order. That was a very age-old controversy under the old section. This is the same controversy into a different format, which says that the person who is issuing me a show cause notice cannot be a person which is different from a person who is passing my reassessment order. This is one reason. Second reason is that there is another section, section 151A, that is a section of faceless reassessment proceedings. Now that section of faceless reassessment proceedings is also with effect from April 22. The question is that when you have a section which is specifically made for doing reassessment provisions faceless, how can you continue to have the jurisdictional assessing officer issue you the notice? So this is a jurisdictional issue, this is a legal issue, and in this context, Bombay High Court is in favor of the assessee, saying that the entire assessment proceedings are bad in law, because from 147, issuance of notice under section 148 capital A had to be done by the faceless authority and not by a jurisdictional assessing officer. Since the initiation or issuance of notice itself was wrong, it was faltered, the entire reassessment proceedings are required to be set aside. Now, this has such far-reaching impact because there are more than 5 lakhs to 10 lakhs cases of reassessments pending which are done in the same format. Now, definitely we know that there will be revenue which will be going before the Supreme Court and we will have that continued litigation. But if we have something like Ashish Agarwal case coming into picture for reassessments, then it will have a far-reaching impact on all the reassessment proceedings which have been done up till now. Because all reassessments up till now are issued by jurisdictional AO and order is passed by faceless authority. So this is a major controversy which is going on. What do we know right now when we are doing practically our faceless assessments and appeals is, since we know that this is an active litigation matter, when we are filing every reassessment order which has been passed against the assessee and you are filing an appeal before the first appellate authority, we are taking a ground of appeal that it is bad in law because it has not, the initial notice was not issued by faceless assessment. So that is what we need to know as of now when we are filing our CIT appeals, so that if at all in future in another 5-6 years Supreme Court is in favor of the assessee, since you have taken that ground, you can consider that entire reassessment as invalid. Although it is looking very far-fetched, but at least it is not worth losing a ground considering that we have one high court which is already allowed in our favor, and I think the matter is pending before another 4 to 5 high courts. We should get their judgments very soon. Now subsection 2. Subsection 2 is a very important section because that is giving away the entire procedure of faceless assessments, of how faceless assessments are to be conducted. So let us go through that. One thing is wherever I have used NAFAC, which is National Faceless Assessment Center, that is an abbreviation for the same. So the first procedure is that the National Faceless Assessment Center will assign cases to AU. AU means assessment unit. Assessment unit is nothing but our assessing officer who is going to complete the assessment, but that has been given a name of assessment unit under the new provisions. Now, how will the cases be assigned? It has been mentioned in the section that it shall be assigned by an automated allocation system. Now, what is an automated allocation system has been given in the memorandum. It has been given that it is a system which is based on artificial intelligence. That is the only information which we have. There is an explanation which defines that it is based on the artificial intelligence system where we random allocation of assessments. However, we do not have any other circular notification instruction supplementing as to how this automated allocation works. So this itself, there are two provisions when it comes to selection of assessments. When it comes to normal assessment, the selection is as per automated allocation system, and when it comes to reassessment, it is through risk management strategy. That is the wordings which is used there. What is a risk management strategy and what is automated allocation system? We have no clue as per the law. So, but what a common parlance would say is that probably they would have certain filters. Like for example, for SFT, specified financial transactions, we have certain filters. We used to have certain filters in the earlier proceedings also. That suppose if you have, for example, deposited more than 10 lakhs in your saving bank account in one single day, then it becomes a trigger for having an assessment. Suppose if you are having invested more than 5 lakhs rupees in one particular slip of mutual fund. Again, it is one of the prominent reasons of why an assessment can be picked up. So what I presume as of now is that there will be certain parameters which would have been set about internally by the ministry and would have been given, and based on that there will be random allocation. It cannot be a random allocation for every other person filing the return of income, because that would be an unfair way of doing an allocation. But since I've just marked things in red which are probably more important or which are something which we do not have any legal standing for the same. After that, there is normal intimation. So one thing under national faceless assessment which we need to know is, I have given the functions of all the units, but predominantly we have 4 units. One is an assessment unit. Assessment unit is a unit which is doing my assessment. Then there is a review unit who is reviewing the assessments. There is a technical unit. There is a verification unit. So there are 4 units under the faceless assessment scheme, and National Faceless Assessment Center is the major contact point between the assessee and all other units. So between the 4 units, if they have to discuss, 4 units means 4 different officers with a different ranking. If they want to discuss amongst themselves, they cannot do it individually on their own. They have to do through a medium which is the National Faceless Assessment Center. Again, all the notices between the assessment unit, between the verification unit and the assessee will be only through National Faceless Assessment Center. Assessment unit, that means an assessing officer cannot directly call you up and say that your assessment is ongoing and I require these details. That is forbidden under the new act or the new section. So the common point of contact, to be very simple, is National Faceless Assessment Center. That is the person to whom we reply and through whom which we get the orders. So that is acting as a mediator, just to simplify that. A notice shall be served obviously under 142(1) and 143(2). So that is a normal procedure. Now, what is the role of the verification unit or a technical unit or a review unit? So whenever a assessment unit, which is my assessing officer, is facing a problem or is stuck while doing the assessment. So suppose, for example, let me give an example of a problem which is there under section 50C. Now there is a valuation of property. Suppose I have sold a property for 50 lakhs of rupees. Stamp duty valuation is around 70 lakhs. Okay, now there is a difference. The provision says that the difference has to be added. Now if the assessee is going to ask for a valuation report, under the earlier provisions it used to go to the valuation officer. They used to pass it over to departmental valuation officer and they used to give their valuation report, give a hearing to the assessee, and based on that the assessment used to be finalized. Now since everything is made faceless, the assessment unit is not a capable unit to do valuation. So assessment unit will ask the permission from National Faceless Assessment Center that please refer this matter to the verification unit, or please refer this matter to a technical unit, because I am not worthy enough to pass an order based on this. So he will need, so whenever an assessing officer is stuck with valuation or with accounts under section 142(2)(a, or is stuck with a controversial issue or a complicated issue, then in that case it is the assessment unit who has to go before the National Faceless Center and tell them that I need help from the technical unit or I need help from the verification unit. So this it has to be done at the discretion of the assessment unit. Once the matter is assigned to a verification unit or a technical unit, if that is gone through to that particular case, verification unit and technical unit will make their independent report. And that report, so suppose for example, one of the most important powers of technical unit is transfer pricing provisions. So earlier, whenever there used to be transfer pricing, there used to be international transaction, every jurisdiction assessing officer would not have knowledge of the international tax provisions, and that is why under the Income Tax Act there was a provision that for these cases you used to have a reference to a transfer pricing officer. Transfer pricing officer is a rank of assessing officer only, but he is that officer who has a specialized knowledge about the international transactions and about the transfer pricing. So in this case, technical unit becomes your transfer pricing officer. So assessment unit will have to go to the National Faceless Center, tell that you please refer the matter to the technical unit. Technical unit will make a report on the transaction and give that report to National Faceless Center. Again, National Faceless Center will give it to the assessment unit. Now, one very important thing under the provision. At no place in the provisions or the section there is a provision that the assessee should also be given the report of verification unit or technical unit. So whatever procedure which is going on right now is an internal procedure. So when it comes to the assessee is only receiving notices, show cause notices and the assessment order. That's it. The assessee is not receiving the reference to valuation officer, assessee is not receiving the reference to TPO, which earlier the assessee was made part of everything, because obviously there was no elimination of physical interaction. So now to a certain extent this is a little unfair for the assessee, because if something is the base or the stem of the entire faceless provisions is bringing transparency, then why not give the verification order, why not give the technical unit order to the assessee also to give a rebuttal to the same. However, that has been left to be given only to the assessment unit. After considering everything and after considering the responses of the assessee, the National Faceless Assessment Center shall ask the assessment unit to pass an assessment order. Now, before passing the assessment order, what if the assessee is not responding? Because that is a very practical situation, especially in the last 3 to 4 years, because people are getting used to the faceless assessment. People were not used to these procedures. People are not getting emails in the notices. They are not getting messages. Most of in the earlier old practices, most of the assessees used to give the email address and mobile number of a chartered accountant or a tax consultant who used to file the return of income, and that person used to have almost their email address and mobile number in almost 500 files altogether. Now that is not possible, because if the CA is going to get 500 notices, they are going to really go bonkers that what is happening. So now it has been shifted, and I think most of the consultants have started advising their clients that you should have your own email address and your own number for having SMS from the authorities. Because of all these procedural issues and the new provisions, there are lots of cases wherein the assessee is not responding. So what happens when the assessee is not responding? In that case, they cannot close the assessment based on ex parte before issuing a notice. There has to be issuance of a show cause notice under section 144, giving one final opportunity to the assessee, and we will get into an extensive reading of the SOPs later on. Once I complete the analysis of the section, wherein they have given a complete way as to how a notice has to be issued, how a show cause notice has to be issued to the assessee. That parameters have to be followed. Those parameters unfortunately are not being followed right now, because that we have seen multiple number of times in multiple case laws. We will come to that when we come to those issues, but procedurally this is something which we need to know as of now. Now after assessee making a reply, there will be assessment unit taking into consideration all my replies and passing an order. Now this is natural. Why would I focus on that? The reason is that we have every 4 out of 10 orders, every 4 orders out of 10 orders are those orders where I have filed a detailed reply and the assessing officer has completely ignored my reply and passed the assessment order or the appeal order. It is very unfortunate to have so, but this is the reality. I am filing a complete detailed response and yet the assessing officer is not looking at my response, just reproducing show cause notice. Now there's one step worse situation in this. That situation is they are reproducing entire show cause notice. After that they are reproducing my entire reply, and after that in one line they are writing but we do not agree and we dismiss the matter. Now this is worst, because in this case we don't even give them the benefit of doubt that they have not seen. Earlier there is a benefit of doubt that probably they must have not seen the reply at all. But here you are quoting my entire reply without giving any speaking order. You are just in one single line dismissing my matter. This is happening unfortunately not only before assessment but more so before the faceless appeals. Many appeal orders these days we are receiving where they are dismissing the appeals left, right and center, just quoting my submissions but not deliberating anything in legal or in facts. So this is what is happening right now, and that is why these provisions that the AU shall take into account all relevant material, this is there in the law. Most importantly, even if something like this is not there in the law, it is a matter of natural justice. If the assessee is submitting something, and it is also a matter of common logic and common sense that if someone is giving something, you have to read through it and then pass an order. It's not something which is a very rocket science kind of a thing which has to be even given in the Income Tax Act, but it is also given in the legal provisions. What I mean to say is that whenever we are getting into a litigation or whenever we are talking about rights not given to the assessee, most of answers to our queries are lying in the written section of 144B itself. So you don't need any case laws. Suppose if your submissions are not considered by the assessing authority, the only thing which you need to know is that there is a section, there is subsection 11 which says that he has to take into consideration and then pass an order. That's it. When the law is very clear, you don't even need controversies, you don't even need case laws of High Court or ITAT. The law itself is enough, and one need not go outside and try to establish their stand by quoting another 50-60 case laws. Rather, it should be read from the law itself. Now, what happens if there are variations? So earlier, a little different approach was done when it came to physical assessments. Whenever physical assessments used to happen, you used to always receive 142.1 and you used to give all the details, right? In the final hearing, after giving everything, we are sitting 1-to-1 with the assessing officer. Assessing officer will finally come to the point for which he is looking for, that what is the reason, what is the thing which he wants to add. Okay, he will discuss that provisions, he will tell us bring these details, we will file our reply to that, and that is how the assessment is getting closed. That is how it used to happen in the physical proceeding.
Madam,
yes.
In case of GST also same physical process, madam.
Yes.
Same, we received ASMT, we received DRC01A, no change in single letter also, DRC01 also. They are not even considering our reply also.
Correct.
I think
It
even
is
based on the officer mindset, I think so.
Correct.
Maybe we would have some fight with somewhere and he is showing our time.
So I totally agree with you that see, most of the time it is the mindset of the assessing officer. That is the reason the faceless assessments has been a mixed bag. We have positive and negative orders both. Right? When in starting I mentioned that is not the true case for appeals. because appeals is totally whitewashed with one thought that you don't have to get relief. I shouldn't say in the public forum, but I think that is what everyone said. It's an unsaid reality. So that is the thing. But when it comes to assessment, there are pros and cons of every new development which is brought into. Still, it has been brought about in 2020 and we are in 24. So we are approaching August, so it will be exactly 4 years to the faceless schemes. I think still it is too early to comment on the success or failure of faceless assessments. But I think as far as I see that now things are getting a little settled. People are appreciating, assessees are also appreciating of not waiting in long queues for 3 to 4 hours before the assessing officer. A lot of corruption has evidently reduced. So that has also been a good advantage. But obviously a very big con is that technology is something, if used rightly, it is going to have its good effects, but if you don't know how to use it, then it is going to have hazardous effects. So that is what is the problem with many officers. Now imagine if you are getting an assessing officer from a very native part. If there is a very big company who is registered, suppose there is a bank who is registered in Mumbai, right? And if that particular assessment is given to a assessing officer which is in a very small district, that person would have never done an assessment of a bank. So that is why it is going to be a little difficult. That is why, so when you receive orders like this, there are two things. One thing is that either the assessing officer is least bothered, or second, he has not understood what is the assessment about, and that is why it has been passed. These are the only two plausible reasons why the assessment orders are coming like this. But yes, it is a reality. However, I think you should always see silver lining in everything. So when you get such orders, it is very easy to defend such orders at the appellate level, because he has not seen anything. So then it becomes you get another chance before the CIT appeal, and you can defend it very nicely before a more learned and experienced officer than the assessing officer, and the chances of getting a good result is better. So probably that is a silver lining of getting bad orders, or orders without any speaking reference. So now when I was comparing, when it comes to faceless, one of the important features is issuance of show cause notice. So whenever there is a variation which is detrimental to me, it is now become mandatory to issue show cause notice. Earlier, they used to issue show cause notice only in case of some substantive additions, like suppose if they are making additions on unexplained income, like section 68, 69 or something like that. In that cases, in physical proceedings, you used to receive show cause notices. You used to not receive show cause notices for every single case. But now every single case, even if there is a variation of 100 rupees, the assessing officer has to issue me a show cause notice. So suppose if you have an assessment wherein there are multiple notices, we have got a relief in one kind of an assessment order wherein there were 7 assessment notices which were issued. The assessee did not reply to a single notice because assessee did not receive the notices. Okay? After assessee not responding to 7 notices, there was directly an ex parte order which was passed. We challenged that order before the Bombay High Court that I was not issued show cause notice. Now the revenue officer had a very valid point to make, that 7 notices went unnoticed. Even if I would have issued show cause notice, the assessee would not have replied to that also. But the Bombay High Court orally gave a deliberation or a verdict that doesn't matter. Whether the assessee replies or doesn't reply, that doesn't matter. What matters is you have to follow the procedure. The law says if there is a variation, you are supposed to issue a show cause notice and give a final opportunity. Even after giving that show cause notice, if assessee had not replied, that is the stage when you pass an ex parte order. So you cannot skip a step. When the steps are given, this is the beauty of this section. Every single thing has been provided, right from passing of who is going to issue notice, who is going to pass the order, who is going to make a draft order. Everything has been specified in the section very beautifully, and that is why the assessing officer cannot skip any single step in that. And so even without replying, because let us be very fair, we have income tax officers who are not replying, but we have assessees also who are not replying. We have lots of our clients who are either not replying. There is one genuine case of not receiving notice. There is one another case of ignoring notices from the department. So we have lot of clients who ignore the notices which are received from the department. They ignore the SMSs which they receive, and in such cases you will have to take recourse to the law which has been laid out. So show cause notice was, I think, one important part. Now after show cause notice, the assessing officer, I have mentioned ILDP, I have forgotten to mention the full form. ILDP is Income and Loss Determination Proposal. That is there in the section. Earlier, in the faceless section of 2020, there was a concept of passing a draft order, which means that after giving all the replies or no replies, the assessing officer has to pass a draft order. Along with the draft order, the assessing officer has to issue show cause notice asking the assessee that this is how I am going to frame your assessment and this is your last chance to make a reply. Now that concept of draft order has been deleted. There is still draft order, but that is only for the dispute resolution cases and the reference to TPO. That is the only where the draft orders are there. Otherwise, draft orders are abolished. Now it is only show cause notice, but draft order has been replaced by ILDP, which is Income and Loss Determination Proposal, which means that after making everything, the ILDP has to be made by the assessing officer, and after making that, he can pass the assessment order. Now this income and loss determination proposal is not given to the assessee. There is no provision which says that the ILDP has to be given to the assessee. But what I presume is nothing, that probably what we see these days is that though the draft order thing has been removed from the Income Tax Act, but the show cause notice which you receive is quite exhaustive. That almost, most of the times the show cause notice itself is the assessment order, the final assessment order. So in most of the cases they have not actually changed the concept. They are continuing to issue a very elaborate show cause notice, and based on that show cause notice you are supposed to make a reply. But this is just a concept which has to be done. Now we referred to technical unit and verification unit. Now when the ILDP has been made, there comes a role of the review unit. Now what is a review unit? Now review unit as per the nomenclature means a unit as simple as that who is reviewing the assessment order or the ILDP which is made by the assessment unit. Now this review unit can be coming into picture only at the discretion of National Faceless Assessment Center. Now, suppose I am the assessment unit, I will not say that I want my order to get reviewed. Obviously, no assessing officer will say so. But after I passing an order, the National Faceless Assessment Center, after reading the order and after seeing the income loss and determination proposal, can very well say that this probably this looks like a complicated assessment, this looks like a complex issue, and that is where the National Faceless Assessment Center has a discretion to send the order to the review unit. The review unit will see the order in complete detailed manner, wherein they will check the computation. We receive a computation sheet with the assessment order. So they will check the entire computation sheet. They will check every single notice. They will check every single reply which is made by the assessee. So it's basically nothing but reviewing everything, but by a person who is an expert. We do not know that who is empaneled as officers under the review unit, but as per whatever discussions which they would have brought about late at the time of e-proceedings, what was mentioned is that review unit has specific task force which is specialized and more academically educated when it comes as compared to the assessment unit. So it has to be an officer who is above the rank of the assessing officer. That is what I presume. I think it is similar to something what we had, that earlier if the assessing officer was not able to pass a very complex order, is to take help of assistant commissioner or deputy commissioner of income tax. Probably it is a similar kind of concept, but this is where the review unit comes into. Again, whatever order which is passed by the review unit is not given to the assessee. So there is no provision under the Act. This is again another provision which is a little unfair to the assessee, because if National Faceless Assessment Center feels that there is an order which is required to be reviewed, that means that there is something in that order which is worthy enough to get it reviewed, then in that case assessee should get a chance to see the order which was made by the review unit, or whether the review unit proposals were even accepted by the assessment unit or not. But that is unfortunately not given. Also, as I mentioned, in cases of 144C, there is draft order. So whenever there is a transfer pricing case or there is a case which is to be done under the DRP, all international tax cases and non-residents by default have an option of dispute resolution panel, which is a parallel panel. So that means that after the passing of a draft order, in case of international tax cases and in case of non-resident individuals, if in such cases the assessee has two options. One option is that the assessee can either accept whatever draft order it is and say that I am okay with this order. In that case, a final order will be passed. Second option of the assessee is that objecting that order. Now, the forum of objecting the draft order is the dispute resolution panel. That DRP is also an electronic forum as of now. Earlier it used to be physical, but now that is also made electronic. So then you go to the DRP. DRP is an authority which has Principal Commissioner of Income Taxes as their authority members. So once you go before the DRP is going to see your case as if a CIT appeal is going your case. So you will submit everything before a DRP. DRP will pass directions, and that directions will have to be forwarded to the assessing officer. So this entire procedure, which was earlier also there, has been brought part of section 144B. So all the next sections which I have mentioned about the draft order, those are all, but I just explained in a simpler way, that once a direction has been given, assessment unit doesn't have an option, but it has to mandatorily follow the directions of DRP. Which means, because DRP is headed by the Principal Commissioner of Income Tax, so it doesn't have any option but to abide by whatever directions have been given. Based on that directions, the assessment unit will pass a final order, and that final order will be given to me by the National Faceless Assessment Center. So this is a case only in case of international tax cases and in case of, which means foreign companies and non-resident individuals. Only in such cases there will be a reference to DRP. In a case where I accept the draft order and I don't want to go before the DRP, at that time the final order will be passed, and once the final order is passed, I can decide whether I want to go before the CIT appeals or not. But I can either go before the CIT appeal or I can go before the DRP. I cannot do both because both are almost parallel jurisdiction. So I cannot go before both the authorities as per law. So this is the procedure when it comes to the dispute resolution panel procedures. And now once this, I think the entire thing has been now provision which is 31, which I have specified, which I have marked in red, is very important procedurally. What it says, once everything is done and I am receiving my order, when you receive an order, you receive three things together. You receive an order, you receive a computation sheet, you receive a notice of demand under section 156 or a refund proposal, and if there is any penalty initiated, then you receive a notice of initiating the penalty. These are the four things which you receive from the Faceless Center. After completion of the entire proceedings, my entire electronic record shall be transferred to my jurisdictional assessing officer. So that means the entire scope of faceless assessment is over for this particular assessment year. Now it goes to my jurisdictional assessing officer. Now once that is done, that means that suppose if I have any problem in my assessment order, which is a mistake, or in my computation sheet, my rectification lies before the jurisdictional assessing officer and not before the faceless assessment board. Because I think many people need to know, because what they do is that there is online, if you have to rectify. Earlier there was a space which was given on the portal where you could give your rectification online. There is also a place for grievance. People use those things for doing a rectification. But actually what you need to do is, as soon as you receive an order, you have to attach the copy of the order and you have to write to your jurisdiction assessing officer. One practical difficulty is that many a times the assessing officer is failing to rectify it on a timely basis. So you can file a rectification within 4 years from the receipt of the audit. Right? Assessing officer, as soon as he receives, suppose I am filing a rectification on 1st of July, there are 6 months which are given to the assessing officer. So by December, by 31st December, the rectification order should pass. But the assessing officer is unable to pass, and they are citing the reason. When we go to meet the JAO, what they say us is that, we have not received the file. We don't have the records, we don't know how the assessment has been done. This is the practical difficulty, because they say that though it is written in the section, it is not immediately getting transferred to us. Now, if it is not immediately getting transferred, what is the problem? It might get transferred in 2-3 months. The main problem is demand, stay of demand. Now, as soon as imagine a case where there is an addition and there is a demand of 1 crore rupees, which is a very high demand, right? Now, in a high demand case, if there is a very big mistake, suppose there was TDS of 1 crore which was not given to me, and that is why it led to such a big demand. Now, if the jurisdiction assessing officer is not ready to take my rectification, there have been cases they are not accepting the rectification letter. Because if they accept the letter, they have to pass an order within 6 months. So they are not accepting the letter, saying that no, we will not pass, you come afterwards. But at the same time, they are forcing the assessee that pay the demand, pay 20% as per the CBDT circular. Because CBDT circular is there that you have to pay 20% of demand if you are filing appeal before the CIT appeal. So that is a actual dilemma in cases of high demands. This is a very big problem which is going on as of now, and we have been repeatedly doing. So what we do is parallelly that we file a rectification letter. If the rectification letter is not being accepted, then we email the letter to the jurisdiction. Every jurisdiction assessing officer has an email address, which you will get it on the income tax portal itself. There is a directory which is issued by the income tax department every year. Every year they issue a directory. You will, if you just search income tax directory contact in Google, you will get that directory, which has detailed contact numbers of every single jurisdictional assessing officer along with their email address. So you can email the rectification letter, because you emailing that also means that you have filed a rectification. So if they are not accepting, you may do so. We file grievance, and in worst case scenarios where the demands are very high, we go and write a letter to the high-pitched assessment committee. So there is something called as high-pitched assessment committee which has been set up. It is a physical committee wherein in case the demand is huge, suppose your returned income is 10 lakhs and your demand is 1 crore, which is almost 10 times of your returned income. In such cases, it will be considered as high-pitched assessment, which means you have to make your case before the high-pitched assessment committee. The high-pitched assessment committee will analyze your case and they will say whether it is high-pitched or not. If they say yes, this is a high-pitched assessment, in that case, your complete demand gets stayed. You don't need to even pay 20%. So you can use that kind of method in case of very high and huge demands, because in huge demands it is very difficult to even pay 20%. It blocks the working capital of the company or the assessee. So even paying that huge demand is a very big problem. So in such cases you can go to those committees and get a stay so that you don't have to pay 20% till the disposal of matter before the appellate authorities. So this is the thing, and this is the procedure as compared to the faceless assessment proceedings. Now coming to subsection 3, which is again a section which specifies what are the units and what are their functions. I have taken a slide which we can read through, but they have just mentioned, this is just a section which says that what are the units all about. Subsection 5 is regarding communication. This is the section which you use whenever you have problem of miscommunication. So as I mentioned that more than 50% of cases pending right now is assessee telling I did not receive the email, I did not receive the SMS. This is the main thing which is going in all the high courts of the country, that the assessee has not been given a sufficient opportunity of being heard. This is the section which says that everything has to be done, all the communication has to be done electronically. The only place where electronic communication is not to be done is verification. So if there is a verification which is to be done, suppose if there is a verification of some property for finding out the valuation, for that the verification officer will actually have to go to the site and see, what is the comparative market rate in that particular community. In those cases, it cannot be faceless. So in those cases, it has to be physical. But apart from that, all communications seamlessly have to be done through electronic medium. Authentication of electronic records. I have specifically mentioned a lot of things here, but most important thing which one has to consider is two things. One is importance of having a DSC or a DIN number. So every notice, it goes naturally, that has to be signed. It has to be digitally signed. Physical signature is not allowed when it comes to faceless assessment provisions. Second is that every notice which is issued has to have a DIN number. Now, there is a matter which is pending before the Supreme Court regarding the same, where I think some of you would have come across that you are receiving an order which doesn't quote the DIN, and suppose the order is passed on 21st of June and you are receiving the order. Immediately the next day on 22nd June, you receive an issue letter which says that this is the DIN number for the earlier order. This is happening a lot these days. What they are doing is they are passing the assessment order on time, and in the second day, on third day, they will say that this was the DIN for that particular order. On this matter, the matter is before the Supreme Court. In High Court, it went in favor of the assessee. That as there is a CBT circular of 2019, I think it's number 6, but I'm not too sure of the number, but it has come up in 2019, which says that every notice, every letter, every order, any single thing which is coming from the income tax authority needs to quote and generate the DIN. So there is generation of DIN and there is also quoting of DIN. So only you generate and you don't put it on the face of the notice, that is not allowed. You have to quote it on the, so when we are reading our orders, these are the things which one needs to look into, because these are the grounds which you will have to take. If you miss this bus at the CIT appeal level and taking it for the first time before IT-80, it is going to be problematic. So these are the things which one needs to keep on checking when you receive the order. Read the notice, read the order, read the computation sheet, that everything has been properly given or not. So the matter which is pending, which I told, is that they have considered that the entire assessment is invalid because DIN was not quoted. Now that revenue has gone before Supreme Court, we are waiting an order. We should receive an order soon. Subsection 6 is the section which says that how the notice has to be sent. It says that every notice has to be sent by placing it on a portal or by sending to the registered address of the assessee. Now, registered address means your email address, not your physical address. Registered address of the assessee or the authorized representative, or uploading on the mobile and followed by real-time alert. Now, let us see what does it mean, because when you take a ground that I did not receive notice, sometimes these kinds of grounds go against you. Why it will? Because people read so many case laws, they read so many decisions that notice was not received, so it is going to get set aside. But it doesn't happen in each of the case. It happens only in cases where they have not followed the faceless procedure. If they have followed everything, if there was a registered email address on your portal which is XYZ, if the same XYZ email address was in your return of income, if they have issued you a notice on the SMS, if they have done everything and still you did not receive because you never updated the email address, then you are not going to get relief. Because so it is not a landmark or a case kind of a it's not a strict yardstick that just because you did not receive the notice you are going to get relief. Let me be very clear, there are lots of negative orders coming these days against the assessee, because they have, and in one of the orders they specifically mentioned that assessee cannot consider this as a yardstick. They cannot keep on getting reliefs on saying because it has been 4 years that now the assessment procedures have been introduced. They cannot keep on taking the garb of excuse that we never received the notice. It is our responsibility to update the address on the profile portal, in the profile information in the ITD portal, as well as writing the correct address in the return of income which has been filed. So, real-time alert is defined under the explanation. Real-time alert means sending a notice by SMS and sending a notice on the registered email address of the assessee. So in a way, there are two things which the assessing officer has to do. He has to upload the notice on the portal and at the same time issue you a notice on your email address and send you a communication on SMS. There has been one High Court case which I'm not going to discuss cases because those are already mentioned, but wherever I come across the analysis, we'll talk about the cases. So that is one case wherein the assessee has received the notice on email but not received on SMS. And they've argued that nahi, SMS nahi aaya. I am not a person who keeps on checking my email twice a day. I am a person who doesn't check my email because I am not into business. Suppose consider an individual who is retired, who is an age of 70, 75, not seeing emails every single day. So that is the reason why the faceless procedure set out for sending an SMS, because that is on my phone. They got a relief from the High Court on that ground that SMS was not sent. So that was one relief which was given. So you also need to see, but for that you need to give your correct mobile number also. If you are giving mobile number of your CA and telling that I did not receive SMS, you can't take that. So that has to be done, but they got a very good relief in that particular case. And subsection 6 also talks about video conference hearing. Now video conference hearings is another important provision which is given under faceless, which gives a hearing to the assessee toward the end of assessment. So suppose if there is any variation, there is a video conference hearing tab which is there on the portal. When you receive a show cause notice, immediately the video conference hearing link is also provided. You have to apply for video conference hearing. Once you apply for video conference hearing, you shall receive an email from the authorities giving you the user ID and password. So there is another website named as Divya Faceless. That website is the portal through which video conference hearing happens. So once you get that, you can discuss your case during the video conference hearing. They will also provide you a link of video conference hearing recordings, so that you have to, if you want to download the recording, you can download it, but it is available only for a few days. So if you want to record, you'll have to do immediately. You cannot wait for 5 months because they will take away the link. So this particular provision was brought about for the only reason that it is a constitutional right of every assessee to be heard. So principles of natural justice says that a hearing has to be given, and hearing can be a oral hearing, or it could be a hearing which is one-to-one. It cannot be an electronic kind of a hearing, and that is the reason why video conference hearing it is a beneficial provision for the assessee. However, I will go one step further and also say, which I have given in the issues, that though it is a beneficial provision, it is not being executed in its true sense. Because what is happening these days in video conference hearing is that there is an officer who is there, the video is off because the assessing officer doesn't have to show his face as per the law because it is faceless. So but I have to, on my video I have to talk, okay? I give everything, I submit everything, make my points. Assessing officer at the end will say, okay, fine. Do you have anything to say? That is the only thing which they talk in the video conference hearing, which is a very bad way. It means that they are doing it only as a formality. It is a formal procedure for them. It is not a two-way hearing. There is one matter of ours itself wherein we have challenged, obviously that matter is not admitted yet, recently, wherein we have admitted the matter before, we have filed an appeal before the High Court saying that hearing is there as per law, video conference hearing is given, but the assessing officer, because in our case when we told them that what is the reason why you want to make a show cause, when we have explained everything, what is the reason that you want to make an addition, the assessing officer refused to reply anything to us. He told us apparently, and we have a recording of the hearing, he apparently told us that we are not obliged to tell you that. That was as simple as that. Based on that video conference recording, we filed the matter before the High Court saying that if a hearing has to be given, it has to be a reasonable hearing. Do not give me a hearing just for namesake. Do not give me a hearing just because it is a formality in the section, because it vitiates the entire purpose of faceless assessments. Now let us see what is the fate of that order. But this is unfortunate, this is what is happening. It is not actually a hearing, it is just your mechanism and your way to show your clients that you have done your job well. That is the only thing which is there, the video conference hearing for.
So it can be recorded.
Sorry?
It can be recorded by us.
It can be?
Recorded.
Yes. We cannot record it. They will record it.
They will record.
So you can record on your phone, but that will not be considered as a legal evidence. If you want to go before High Court, you cannot, because we are not able. And if you any Zoom hearing or something like that where you have the recording rights, here they don't give you any recording rights. So officially you cannot record, but the department is going to record the hearings and give you. Now there is another problem is that in many of our cases last season in March when the assessment orders were there, recordings are not given. They have not, we were checking the portal every single day for those cases which were crucial, but they did not give us the recording at all. For all those cases we have filed grievance that no recording has been provided. We don't even know whether they would have recorded or not. But you have to ask for it. If you want it, then you will have to ask for it. There is also an email address of Faceless. I think you can get it up online. I do not have the entire faceless.samadhan@something that is there. That Samadhan email address is for Faceless. It is for appeal also, and it is also for the third authority. There are 3 authorities for penalty. There are 3 emails which they have given. We write to those emails also.
Then for DRP proceedings also same recording they will provide, because it is happening virtually, DRP proceedings.
No, DRP proceedings you don't get recording. That is not covered by section 144B. So when the DRP proceeding, there is a section 144C which is going on, so that is covered under that section. So then the video conference hearing doesn't happen, plus that is not faceless. You can see the officers there.
Video conferencing, hearing
Yes.
happens online.
Hearing happens online
You can
because
see officer.
correct.
But any recording can we get like that?
No. There you can't get recording. That is not coming under the provisions. Although I have mentioned in the list of other provisions, there are multiple schemes. See, when Faceless came, at that time, by way of TOLA, there were so many other sections which also came along with it. Like verification will happen faceless, rectification will happen faceless, DRP will happen faceless, ITAT will happen. So many sections they touched. And in some of the sections, every section there was a time limit that it should be, government should bring a scheme by 31st March 22. 31st March 22 was a common date which was given. There are surprisingly 3 to 4 schemes where no scheme has only come and they have not even extended the provisions. So section has been introduced that there will be a scheme which will come, but there is no scheme which has come. Now if they want to bring some scheme, they will have to make a retrospective amendment, which I think the government will not bring now. So those sections basically are redundant in the income tax provisions because you cannot do anything about it because the deadline has gone. So one of the section is dispute resolution in that. So subsection 8 says, which is a very specific and a highly onerous powers which are given, that if you want to at any point of time transfer the proceedings from faceless to jurisdictional assessing officer, then the Principal Chief Commissioner can do so, but with the approval from CBDT. So this will not happen in all the cases obviously, but in case if there are certain very high influential cases or very high tax fraud kind of cases, then probably in such cases they may not want to do it faceless, they may want to do it physical. So in that case it has to be done at the discretion of PCCIT. Now these are the functions of various units which I have mentioned. Some of the things which I have already discussed. I think many parts of the PPT which I have kept is just for a reading material or for reading sake. The only thing which we need to see here is that when it comes to cross-examination, because lots of reassessment provisions are done based on investigation reports. There are search which happens in some particular entity and based on that statements you are receiving a notice. So lots of reassessments happen based on the investigation. In that case, if you want to do a cross-examination, then the cross-examination powers are with the verification unit. So the assessing unit will have to ask the help from the verification unit, and the cross-examination cannot happen virtual. Cross-examination has to happen physical. So then it will go to verification unit and verification unit will tell the assessee to give some date and time, but I have not seen a single case where cross-examination is given to us. We have been asking that every single now and then. They have not provided cross-examination in any of cases. In fact, I'll go one step further and say that we don't even know whether this verification unit or review unit exists. For one reason, the kind of orders which we are receiving. If there would have been a review unit, why we would get this kind of orders which are being passed right now? And verification unit, in all cases of valuation, in other cases, nothing has been done, They are just passing orders. So we don't even know whether these units are just on paper or whether they are actually executed also. But I think probably in time to come we'll understand more about it. Now, time and place and dispatch of notice is governed as per section 13 of IT Act. I have reproduced the section 13 of the IT Act here, but the entire, it's very confusing as a section. The entire essence of this section is that the time and place of the notice, since everything is now online, is governed by section 13, and section 13 says that whenever I receive the notice, suppose the assessing officer is putting it on a portal on 21st of June morning 10 o'clock, but I am receiving that at 5 p.m. in the evening on the next day, then for me the receipt of notice is the next day. So this is what the section says, that when shall it be considered the receipt of notice, because obviously when you receive the notice, your 30 days meter of filing appeal starts from that date. So it is that thing which is mentioned here, nothing too specific. They have again not used this section 13 anywhere. I have not seen a single case where they have invoked this section 13 of Information Technology Act. Registered email address, I don't have to discuss anything here, but it is a very important slide for every one of us to see, because as I mentioned that we cannot keep on crying before the officers that we did not receive notice if they have issued notice on any of these email addresses. These are the email addresses which are mentioned in the section itself. So for example, email address on the portal, email address in your permanent account number. So suppose if I am staying in Mumbai and I shift from Mumbai to Bangalore, so you will be given presentation. So if you are going from Mumbai to Bangalore, okay, I am shifting permanently. Now if I am shifting permanently, I will have to change my registered address. If I don't change my registered address and I continue to get notice there, I cannot plead that notice has not been received. Similarly, because there are, now when I apply for Aadhaar, now when I apply for PAN, I have to mandatorily give my email address. So it has to be changed. Even the physical address needs to be changed, but email address has to be changed. When it comes to company, it is the email address as per MCA records, right? And also the email address, which I have not written here, but another email address is important, is the email address which you give in your form 35 and form 36. Now form 35 is the form of filing appeal before CIT appeal, and form 36 is the form which you file before the ITAT appeal. Both of these forms have made it mandatory to give email address. So you ensure that you give a correct email address there. Now coming to faceless appeals. We've done with faceless assessments, coming to faceless appeals. As I mentioned, section 250 was always there in the Income Tax Act. The only change which has been made is under section 6B to 6D, which is the section which authorizes to bring this faceless scheme. It authorizes the central government to bring these schemes. Nothing else has been changed in the section. So the only thing which is important, not from the procedural point of view, but from the practical point of view, is subsection 6. Now subsection 6 was always there in the Income Tax Act. It is not something new. What does the section say? The section says that the powers of CIT appeal and the duties of CIT appeal are far wider as compared to assessing officer. That means the provisions of passing an ex parte order. What is an ex parte order? Ex parte order is an order when the assessee does not respond and the assessing officer has to pass the order. CIT appeal doesn't have an concept of ex parte order, which means suppose if before faceless CIT appeal, I did not file replies, right? I never filed replies, I was ignorant of the fact. Can the CIT appeal dismiss? The answer is no. and the reason is subsection 6, which means I have filed my grounds of appeals, I have filed my statement of facts. CIT appeal is a second authority. First authority is assessing officer. So CIT appeal already has my assessment records, and it can call for, if it doesn't have, because it has the powers to call for the assessment records, it already has my grounds of appeal, it already has my statement of facts which are filed. In that case, if the assessee is not replying, the appellate authority has to look into the merits of the case and then pass a speaking order. CIT appeal cannot pass an order saying assessee did not reply and hence I don't have any option but to dismiss the matter. Let me tell you, in 9 out of 10 cases, probably it could be even 10 out of 10. In 9 out of 10 cases, when the assessee is not responding, the CIT appeal is just dismissing the appeal. They are not adjudicating on merits. And then we go to ITAT. ITAT will batch the CIT appeal, give some words and tell him that set the matter back to the file of CIT appeal for giving a fresh hearing. So this is a round of litigation which has increased, but it doesn't have to increase because it is specifically mentioned under subsection 6. So if you are receiving an order, where the assessee has not replied and it has been dismissed, please go and file appeal before the ITAT appeal because of this subsection, and you will get a relief. You will get one more opportunity, even if it is your client's fault of not responding, but you will still get an opportunity to go and file your submissions once again. Now, the faceless appeal scheme which I have mentioned, again, faceless appeal schemes were two. One was in 2020, then that got abolished, and then came a new scheme which is 2021. That scheme continues. Procedure I will not discuss because it is more or less similar to National Faceless Assessment Center where you file, but again when it comes to faceless appeal scheme, you do not have technical unit and verification unit and all those things, because CIT appeal itself by stature is an authority which is quite experienced and at a higher level in income tax. So you don't have those units, you have only CIT appeal. Earlier there was review unit, now they have removed that concept. So now there is no review unit, there is one single CIT appeal who is doing your appeal procedure. So that is it. When it comes to that, the only thing which I would specify is that there are a lot of provisions which are made for condonation of delay, for acceptance of your additional grounds of appeals, for withdrawal of appeal. However, there are lots of cases where you have filed appeal late and they are dismissing your appeal without giving you any notice that why the appeal should be considered. So what practical tip which I would probably give it to all is that whenever there is an appeal which is filed delayed, which means which is filed beyond 30 days, in those cases you have to mention the condonation of delay, you will have to mention a reason, and you have an option to make attachments. So in that, as a healthy practice, what we do is that we file an affidavit of why there was a delay along with our appeal papers itself, so that we don't give any scope for them to pass a dismissal order. So that is the one thing which one needs to see, but otherwise the faceless appeal scheme procedures are more or less same. Again, we have video conference hearing provisions enabled before the CIT appeal also. So in every case, the only difference is when it comes to video conferencing hearing before the CIT appeal, there is no requirement of any variance. So you can ask in every single case. So we make it a habit that in every case of CIT appeal, we ask for video conference hearing, because in that case there is no question of show cause notice, because before CIT appeals there is no question of show cause notice, there is never a show cause notice sent. There is a single issue which is in question which they have to deliberate upon. So you already know what is the issue. That is why no need and reason for issuing a show cause. So in such cases, every single case as a matter of right, you will have to ask. Now there have been cases in the High Court wherein the assessee has argued that the video conference hearing was not given. In those cases, it was held against the assessee, saying that hearing will be given only if you ask for. It is not a right which will be given to you suo motu in all the cases. So they are not going to give you video conference in every hearing. You will have to ask for it, only then they will give it. So make it a point to ask for it if there is a case which needs to be discussed. E-appeal scheme, I have already mentioned in the beginning that e-appeal scheme was a scheme which was brought about to reduce the pendency. This is a scheme which doesn't fall under faceless. It is called as e-appeal for the reason that it is issued by Joint Commissioner of Income Tax Appeals. However, that Joint Commissioner of Income Tax Appeals designation will be written in the notice. So suppose if you have been receiving notice from Chandigarh, that address of Chandigarh will be given. So this is not a faceless notice. However, the entire procedure is electronic. So you are not meeting the officer or you are not submitting anything, you are submitting everything on the portal. The order is also received by that. All what we have seen is all smaller cases which doesn't have very huge liability are being shifted to Joint Commissioner of Income Tax Appeals. So you might receive some cases where earlier it was under faceless, but then you received a notice from Joint Commissioner of Income Tax Appeals that please give me the submissions. So in such cases you have to file submission once again, and then the order will be passed by the Joint Commissioner of Income Tax Appeals. So this is the procedure which has been laid down by the Joint Commissioner of Income Tax. Again, not a very elaborate procedure, but I have just given the scheme. Now coming to standard operating procedures. Now what are standard operating procedures? This is the first time when there are SOPs which were brought about, because faceless assessments was considered as a very historic kind of a development when it came to income tax proceedings. Let me tell you one very interesting information. India is the first and the only country in the entire world which has faceless assessments and appeals both parallelly for all our cases except for 10% of exceptions. There are no other countries, because I had done an elaborate research of which countries have what kind of assessment procedures. What I found in my research is we are the first one. So we are torchbearers when it comes to faceless assessments and appeals, and that is why I think we all have lot of negative points, but we all need to be proud also about the fact that we have adopted technology foremost when we were very backward as a country while adopting technology, because we have been 15 to 20 years backward when it comes to developed nations. So it is a thing which is worth applauding.
Madam,
yes.
first country or only the country?
No,
Have any other countries?
we are the first country for faceless. So there have been electronic proceedings in USA, it has been done in Canada also, in fact even Singapore. But they all have an option to meet the officer also. So one thing which is different is in whichever countries the proceedings are electronic, those proceedings are electronic to give convenience to the assessee. In our case, it is not the matter of convenience. In our case, it is a matter of bringing transparency. So the objective is very different. So India becomes the first country for that objective. For objective of bringing on paper. See, we have brought on paper that we want to reduce corruption. That has been even spoken by Prime Minister verbally when the things were issued. So we are bringing it, we are accepting there is corruption, and then we are bringing a scheme. So that way we are the first ones to do that with this kind of an objective. Now coming to SOPs, so there are detailed SOPs. You can go on the income tax website and you can find SOPs and you can read it in detail. It is a very simpler language. But the things which are important I have specified here, and the things which I have marked and highlighted and read are more important. One important thing is that in case of best judgment assessment I have mentioned, which means when you are not making any reply. In those cases, it has been mentioned in SOP that if there is no verification required, which means it is not a case of investigation, it is not case which is based on the statement recorded of any party. If it is not a verification case, it is a regular case. In that case, you have to pass an order which is in favor of the assessee. It has been mentioned in the SOP that you should complete the assessment on best judgment and you should accept the returned income. The language which I have written, I have quoted from the SOP. So this is very surprising because it is a very beneficial provision and we hardly see beneficial provisions in Income Tax Act. But at the same time, my reason for drawing your attention was that we could use SOPs also. There have been multiple cases in High Courts and Supreme Court wherein the assessee has used that SOPs are meant for a reason. Though they are not binding by law, but still they are SOPs. The assessing officer is required to follow the SOPs. They are for a reason, and if you see that there is a normal assessment, but there are some additions which are completely absurd, then you can very well use the SOP provisions. It will really help. Another thing is, which is again very interesting, is penalty notices. Now, what is section 272A? I think you have penalty just the next session. So, section 272A penalty is basically for non-compliance of any notices or for non-response. So, in this case, the SOP mentions that I should be given a time of 15 days. Why I am mentioning and hard pressing on this is because we see that they are giving us 3 days notice, they are giving us 5 days notice. There have been matters wherein they are issuing me a notice on Friday evening, asking me to make submissions on Monday morning. So when the SOP itself says that a reasonable time period for the assessee is 15 days, how can the assessing officer just close the assessment in 3 days and pass an order on the 4th day? Right? So this is the SOPs which are already, one thing is that there are good SOPs, another thing is that they are not following the SOPs. But if they are not following, we need to draw attention at the appellate levels that even the SOPs, see these smaller things which will have an impact, a positive impact to get a favorable order at the appellate stage. I think technical unit, I have already mentioned that there is a reference to TPO, that is the major function when it comes to technical unit. When it comes to verification unit, a major function of verification unit is issuance of 133(6). One interesting trail is that in lots of reassessment cases, in cases of penny stock, in cases of bogus purchase, in case of fictitious loans, all of these cases, the additions are made under section 68 or under section 69C because they say that the assessee could not bring the person for verification under section 133(6). So, or if you all are aware, there is a lot of controversy going around that I gave my bank statement, I gave my balance sheet, I gave the balance sheet of the third party also, which is considered as an alleged accommodation party. I gave everything. The only thing which I couldn't do was not bring that person before the authority. So, verification unit says that notices have to be issued by seeing the digital footprint. Now, this is the first time in digital footprint words are used in Income Tax Act. What do you mean by digital footprint is that when you are having a PAN card and when you are having an Aadhaar card, you are creating a digital footprint for yourself, which means that wherever you are putting your PAN and Aadhaar card details, whether it is MCA, whether it is SEBI, whether it is ROC, the Income Tax Authority has a discretion and power to use the digital footprint and locate the person which I am not able to locate. So, if there is an accommodation entry provider, I am not able to provide that person before you, Income Tax Authority has the power to find the whereabouts about that person and then issue a notice to that person. So, in all those cases which are against me, just because I could not provide that person, we can use the SOP saying that it was the onus of the assessing officer to follow the SOP and find that person and issue a notice rather than telling me to bring that person on record. So that is the reason why that function is important. Review unit is just generic stuff, so I'll just slide it across. SOPs for penalty schemes. Now, one important part when it comes to the penalty, so faceless penalty scheme I have not taken because we were doing assessments and appeals, but there is a parallel scheme for penalty orders also, right from passing penalty order before the authority, assessing authority to the CIT appeal. There is that penalty scheme, but in the penalty scheme there is a very interesting SOP which is given, which is how to handle non-responsive case. Non-responsive cases means the cases where assessee is not responding. So this is the place where they have mentioned that if email ID is not being seen, then you have to issue a notice through speed post on the registered postal address of the assessee. So this is the place, this is also the provisions which we are using in many cases. Suppose there is a non-resident assessee, right, or there is an assessee who is a senior citizen, or an assessee who has changed the email address totally and was not aware. In such cases, if the assessee is not responding, it is the duty of the assessing officer to send one physical notice on the physical address through speed post. And also there is another important thing it says is that if suppose there are 5 notices which has been issued and the assessee did not respond to any notice, then And the last notice, what the assessing officer has to do is, he has to find out all the email addresses based on the digital footprints. The email address which was there in, suppose in my MCA record, the email address as per my PAN card, Aadhaar card, the email address as per my last income tax return file. He has to find all my existing email addresses which he is available and send notices on all email addresses and then pass an order. So these are quite beneficial provisions which are there in the SOPs, and if we are aware about the same, we can definitely use to our discretion and for the benefit of our clients. Now these are certain recent circulars on compulsory selection of scrutiny assessments, not related to faceless assessments but related to assessments. So I have mentioned that, but I am going to pass through that because I have just given that for the information of the participants. Now these are the other provisions. Now when I mentioned that there are several other schemes which came along with faceless assessments and appeals, these were the schemes. So there was one scheme which has been brought about as faceless jurisdiction of income tax authorities. Now this scheme is under section 130, which is the jurisdiction of the authority. It came with effect from March 22. Now this scheme has such wide-reaching impact. It says that all jurisdiction which is there under section 130, everything has to be faceless, which means which covers everything, which covers my verification, my account auditing, my reference to 142A, it covers my surveys, it covers my verification under 133(6), it covers everything. Section 130 provisions is basically jurisdiction of income tax authority. Now I did try to understand by reading this section and I tried to discuss with other authorities, other colleagues of mine. We do not understand that what is the reason of bringing this particular scheme. There is a scheme in place, the scheme is not to elaborate, and it makes all the income tax authorities faceless, all the interactions, which is not happening, because right now there are a lot of things which are happening physical also. But we don't know, because if one starts to implement or someone objects this particular scheme, it is going to make an amendment in the future. 151A I have already discussed, that is a section of faceless reassessments. So right now we have 3 sections for reassessment. Section 147, Section 144B and Section 151A. And that is why there is controversy that reassessment, if you have to do under which section. 147 is basically showing that how a reassessment or in which conditions reassessment has to be done. 144B are procedural provisions and 151A is faceless reassessment provisions, and there is a scheme also which came in 2022 for that. So when there are parallel provisions, and I think somewhere or the other, by bringing so many faceless schemes, somewhere or the other I think the authorities have also messed up a little by bringing parallel schemes, and now there is a question of jurisdiction, that which section will apply, which scheme will apply, and that is creating a lot of confusion. But we need to know that provisions, these are all other sections which you could read, but I think all the last sections like revision under section 263 and 264 was also to be covered under faceless. That extension did not ever happen. That was last date was 31st March 22, no scheme came. So that means now revision 263 and 264 will not happen faceless unless they are bringing something new. But they are going to continue to be in the physical format. One of the things which people have started doing, interesting thing which I share is that when an assessment order is passed, you have 2 options. One is to file appeal before the CIT appeal. Second is an option where you file for revision application under section 264. Wherein you go to the principal CIT and not CIT appeals. Many people have started using 264. Why they have started using 264? Because they know before CIT appeal the disposal is not happening for 4 years, 5 years. Whereas for 264 there is a time limit to pass the order within 1 year from the application date. Also it is physical and this is faceless. So people have now started using the revision application provisions which were not used so much in the past. But now we have seen a trend that it has been increasing. So these are all recent circulars and certain legal issues. So legal and practical issues, many issues I have tried to cover when we were talking about the schemes, and I have made some 7-8 slides quoting all the case laws which I could find on these legal issues, which could be a good reading material. But there are still certain issues which are pending and which we don't know what is the fate of. One is non-speaking orders. Now, non-speaking orders is a very big problem when it comes to faceless assessment. Now, in a situation where it is against you, they are, as I mentioned, they quote everything and then they say that we are not in agreement and they add everything. In such case, though, it is definitely detrimental, but you are going to file before CIT appeal. Now, consider a reverse case. Consider a case where it was a complicated case. You gave everything, you submitted everything, they gave everything in the order, and then they are making one-line order that we agree with the assessing. Now, generally, speaking order is not only important when there is an addition made, but it is also important when a relief is given or when they are accepting your returned income. When there are orders, we have favorable orders where we are happy, clients are happy that we have received, no addition. But we have received 263 notices. There are multiple 263 notices, multiple reviews which are happening by principal CIT on the only ground that the assessing officer has not considered the submissions appropriately, and that is why it is prejudicial to the interest of revenue. So even when an order is in your favor, but it is not a speaking order, still you always have that that knife hanging on your head that it might be reviewed by the principal CIT. So speaking order is absolutely essential, whether it is against or whether it is in favor. That is one thing which is important. Another important issue is set aside cases.
Time limit for revision?
Sorry?
Time limit for revision?
It is within 2 years from the end of the year in which the order has been passed. The assessment order. So then set aside cases. Now what has happened is that all those cases, because of all these procedural defects before the assessment or before CIT appeal, we go to ITAT in the normal route or we go to the High Court. Wherever we go, whether we file a writ petition or whether we file an appeal, all of these cases where no procedures are formed perfectly, they are getting set aside. Now we have got a very big dearth of appeals which are set aside, but there is no resolution. Those appeals have been set aside since 1 year, 2 years, 3 years. Assessing officer is not calling for it, neither the jurisdictional officer is calling, neither the CIT appeal. So you have got that matter set aside, but when you go, now problem is it's faceless and faceless CIT appeal. If you go for the order giving effect to the ITAT, of the ITAT order to your jurisdictional assessing officer or your jurisdictional CIT appeal, they refuse to accept and they say that this doesn't come into our jurisdiction. You will get a notice from faceless officer or faceless CIT appeal. Now, I have no mechanism to go to faceless assessment or faceless CIT appeal because I have no access. So that is the reason why it is stuck. The only thing which we are right now doing, a practical solution, it's not a solution as such, but what we are doing is we are writing to the principal CIT. Because principal CIT is above faceless assessment and above faceless appeal. It is the highest ranking authority, principal CIT and principal chief commissioner under the income tax. So we write to them that it has been so many years and we have still not received any notice and our demands are lying. We are getting recovery notices every single month from the assessing officer. Please consider our application. So this is the only thing which we are able to do.
But in that case, any movement is there, madam? Any lucky you got nothing?
In one case, we got an early disposal, not for the set aside case, but there was a very old case and my property was attached. The only property of the partnership firm was attached and the partnership firm had already dissolved. So, both the partners had expired actually. And then we wrote all of those things and we went to PCIT and they immediately got a notice from faceless CIT appeal and there was disposal also which happened in 1 month. That was only one case out of probably around 50-100 cases which you would have filed before PCIT. But otherwise nothing is happening.
We filed multiple times, madam, for early hearing.
Sorry?
We also filed early for nothing.
Nothing. We not even getting a hearing, a proper hearing. So these are the things. I have already mentioned that we don't know what is a risk management strategy or something like that. There are multiple cases and this is one of the biggest issues under faceless assessments and appeals is on not giving sufficient opportunity. Either not giving opportunity at all or not giving sufficient opportunity or reasonable opportunity. So as I mentioned, we are getting only 3 days, 4 days, 5 days, weekends These are the kind of opportunities which we are getting. I have just quoted some 10-20 cases, but there are thousands of cases which are of the assessee that opportunity to be heard has to be given. The only unfortunate part is that, as I mentioned at the very beginning, that subsection 9 was deleted. That subsection 9 gave the power to quash the order at all. But since that section has been removed, now they cannot quash. So what happens is they go back to the CIT appeal or AO and say, now you give fresh opportunity. So unfortunately that, you cannot remove that order from the system. You have to again go back under the ordeal and make your submissions. You are given relief, but it's a kind of a part relief. But this is the most important issue which is going under faceless assessments and appeals. Video conference is a one-way street. I've already discussed that. And recently we have seen is cyber threats. Is that when you are putting, because though they have lots of IT security concerns, but we have these days seen that lots of emails are being received, fraud emails are being received of your confidential information which you are submitting. Now this is one portal or one resource where you are submitting everything confidential to you. There is a risk that if that gets hacked, or there is a risk that they are taking, many people are suspecting that they are taking information from our PAN records, from our bank records, and there are multiple notices which are received, not notices, multiple emails that you have done so much transaction or so much amount has been. There are lots of instances. If I start talking about that, I think there are lots of instances. But we all need to be vigilant when it comes to cyber threats. We can't do anything about it, but it is one of the cons of the faceless assessments and appeals, and we'll have to have strong IT systems in our offices too, because when we are making submissions, we are giving our IP address. So we need to have firewalls, we need to have security systems. We cannot have a normal computer without an antivirus, because it might get hacked and all your confidential information which you are putting into may get leaked. So that is one thing which we'll have to start working. I think I've given in the practical tips also. We all will have to start working on developing our offices, the infrastructure, the IT infrastructure, whether it is software or hardware, that has to be continuously done. So these are all the jurisprudence cases which I have covered. Mostly, it should have a reference value because they are all of Supreme Court or High Court. Some are old, most of them are new. All of these cases in this particular slide are on not giving opportunity. So not giving sufficient opportunity, using empty formalities, which I had mentioned about video conference hearing. So these are all such cases where speaking orders should be given. One interesting case law of Calcutta High Court of Indu Goenka, where SOPs were not followed. As I mentioned, that SOPs are not part of legislation because it is neither in the Act nor in the rules. But not following SOPs is gross violation of right of the assessee. There is one High Court judgment based on that. Okay, lots of orders where only 1 day was given, 2 days were given, 3 days were given. So I think these things which we can probably use. All of these cases are on video conference hearing. Another thing which is happening is when you take an adjournment, every time you take an adjournment, they don't give you a notice. Like if you have adjourned, they don't give you a fresh notice to you. Probably you might get notice after 3 or 4 months or something like that. Sometimes they pass an order without rejecting your adjournment request. This has happened many times. So these all case laws, and I've just quoted 3, but there are multiple, which says that adjournment request also they have to reject. They cannot just straight away pass assessment order or CIT appeal order. If there is a genuine reason and I'm asking for an adjournment, it may be a 3rd adjournment, it may be even 10th adjournment, but they have to reject my adjournment and then they have to pass an order. They cannot just straight away pass my orders. And these are certain practical issues which are covered, but I'll just take 1 or 2 of them. One is obviously the issues with video conference. So see, video conference facility, apart from recording not being available, etc., there are a lot of issues in video conferencing. Like they give you user ID password, but you are not, when you go on the designated date and time, nobody is there, or the entire website is blank, nobody is listening to you, you don't get response. if you file an adjournment, now see, when you are asking for video conference hearing, they give you a time and date based on what they want. Suppose if you are not available, in most of the cases, if you take an adjournment, first of all, you can take only one adjournment for video conference hearing. If you take an adjournment, we have seen that they are not granting adjournment, they are straight away passing the order. So they are not giving adjournments under video conference hearing. They assume that you should be available 24/7 for the income tax department. So, try to not take adjournments. That is one of the practical viewpoint. But if you have to do that, if your hearing doesn't happen or they consider it as a hearing, what we always do at all the parameters of assessments and appeals, we maintain lots of screenshots of technical errors, because those screenshots help. We take screenshots with the date of the computer to show that we tried. See, when you make and take the screenshots, you show that you tried, you complied to, but enough opportunity was not given to. Whenever if you're facing problem, even technically, when you're sometimes when you're making too many attachments, also there is a problem. They are not taking certain attachments, and the website crashes. Many a times it is the last day and the assessment order has been passed. Sometimes it is the last day and they freeze the assessment field itself. They don't let you make any submissions. So in all such cases, maintaining screenshots is going to help you further. So that is all which I would say. And lastly, I think which I've mentioned is that one extremely important thing about notices not being received is, I think all of us have to check or let the client check that the email addresses and the SMS's accounts, number details, profile details, everything which is given is of the correct person, of the authorized person. Because if the assessor is looking the notices on time and is giving to us on times, I think most of our major problems with compliances are going to get solved. So I think since they are not aware, or either they are aware but they are taking it lightly. So I think as CAs, it's our responsibilities to keep on telling them that if you do not receive notice, we are not the ones who are going to make your replies in a single day or two, or going to file your appeals for non-appearance. So I think that is a good approach and a way to understand and make the client also take the responsibility of the faceless assessment and appeal procedures.
What is it? Can you give this some example for use RTI as a tool?
Sorry?
RTI.
Yeah, so RTI is basically, as I mentioned, that verification report is not given to you. Review report is not given, technical report is not given. Now suppose if you have a case where you feel that review was required, suppose there is a valuation which is done and it is written in the assessment order, but you are never given, so you can go to RTI and call for your own technical report. So that could be tried. Now another thing is that lots of times we had a website transfer which happened. We had software companies which had changed. We had Infosys taking over from ITC, and we had the entire software revamped. In that case, lots of electronic data got lost by the department itself. For almost 6 months to 9 months, we were not getting any notices, we were not getting any submissions which we had made. In all such cases, you can write to RTI to call for your own records. And that you should use it in such situations where you lose your data when it is not available on portal. For example, 143.1. Now when you issued a notice under 143.1, which is an intimation basically, you receive it by email, but it is not there on the portal. Anywhere on the portal you see, you will not get intimation under 143.1. You will get only for initial days. If you see after a year, it's gone. So there is a request mode where you can make an application, but there also sometimes they don't give. So if you don't get, then also in that case you can make an RTI and get your intimation under 143.1. So that is how you use RTI. So whenever the normal procedures are not working, that is the time when you use grievance, that is the time when you use CP-gram, that is the time when you use those Samadhan email addresses. Another thing is emailing at the address of the jurisdiction assessing officer, meeting the jurisdiction assessing officer. So these are the alternate remedies which you should try apart from knocking the doors of High Court. So these are the things which you should try first and then probably file a writ.
And you were talking about IPH assessment.
Yes.
Is there any link for that?
I don't have it, but I can send it to the coordinator and they can give it in a group if it is formed, so right? And I can even mail you. If you drop me, my email address is here. The PPT will be given to I think everyone, so you could drop anything I may not be available for questions because I have to leave immediately. But if any queries are there, I think you can just post it to me and I'll try my best to answer to those queries. And you all have been a very wonderful audience. Thanks a lot.
Thank you very much, ma'am, for the wonderful session. On behalf of ICA Bangalore branch,
Sorry.
we thank you for the wonderful session, and as a token of gratitude, we present a memento. There's anybody has card number 8844 required to be removed for taking the other vehicle. Card number 8844. Okay, on behalf of Bangalore branch of SARC of ICA, we thank you for the wonderful participation, and we'll break for tea and reassemble at 6:30. This session we had earlier planned for Sri Deepak Chopra, as he is not available for some reasons. We have alternate speaker C.A.R. Abhishek Murthy. I request the speaker C.A.R. Abhishek Murthy to dais. He is a fellow chartered accountant, certified course on transfer pricing, and he has Bachelor of Law and Bachelor of Commerce. About 9 years of experience in advising and assisting clients in various areas like personal taxation, audit, corporate taxation, international taxation, transfer pricing, and litigation. He is a practicing chartered accountant. He carries extensive experience in tax and financial services. He is a regular faculty at various teaching institutes, inspiring the next generation of chartered accountants. With this brief introduction, I hand over the session to the speaker.
Thank you, Mr. Pramod. So, for today's session, we have chapter 20B and chapter 20A, B, C. These three chapters, they were mainly introduced to basically restrict certain transactions, right? A was introduced. Chapter 20A was introduced, and it was meant basically to stop transactions where there was sale or purchase between two parties and the transaction price, especially in immovable properties, was below the market value. So central government was saying that just in case you have a transaction and the price, the sale consideration is much lesser than the market value, then I will only purchase the property from you, right? That was your 20A. And 20A was removed, and then 20C was introduced, which came with the same law, came in a different manner. So these chapters 20A, B and C. So 20A is related to central government trying to acquire properties which were mainly concluded with those market value. 20B was mainly chapter mainly introduced basically to say that if certain transactions were conducted in certain manners, there will be a levy of penalty. And 20C was introduced after removing 20A, but the law is pretty much same.
Now 20A and 20C have been removed. Now 20B is still in the Act. Now 20B basically deals with what? It deals with if the transaction has not taken place in a certain manner, then the Income Tax Act will come into place and they will levy certain penalties. Okay, and now this law basically tries to take action in two areas. One, if any transaction, whatever is conducted, if it doesn't come into anyone's book, then there is an issue. That is with respect to cash transactions. Okay, if it doesn't come in any books, then it tries to cover those transactions. And second, if certain transactions are not reflected. So one angle is, if the transaction is not reflected, then you don't end up paying income tax on that. At the same time, if the transaction is not reflected, you don't pay indirect tax. So two different laws, two different tax revenue mechanisms will get nullified if the transaction doesn't get reflected. So to counter this, we have this chapter 20B. So in chapter 20B, what we are going to cover? One, we will try to understand the background before we go into the main law, to understand how this was mainly brought in, or why this was mainly brought in, what it mainly tries to address. That's first thing. Then we try to understand 269SS and 269D. 269SS basically is going to address transactions where you are accepting loans, deposits, or specified sum. And 269T is going to address whatever you accepted, now you are going to repay. So what happens in those situations? How should you repay? Then 269ST, this was brought in after demonetization, and this mainly, or at the time of demonetization, so this was mainly to say that, or to promote digital payments, and basically to address the to make sure that indirect taxes are correctly captured. So that is mode of undertaking transaction, which mandates that you can't take more than 2 lakh rupees of cash. Then 269 SU, this was brought in to promote digital transactions, wherein it said that in addition to your regular online transactions, you should also accommodate for the new transactions like UPI and all those. So you should have a mechanism to receive money through that. So it is becoming mandatory. So these are the main 4 transactions which we have. Now the mechanism or the way in which these sections work is, we have these sections SS, T and all these things, which have a limitation to say that okay, you can't do this. Now what happens if you do this is not there in this section? There are penalty provisions which are parallel to this, and each of the penalty provisions also has a remedy also, which says that if you have a reasonable cause, then we will not levy penalty. So that is how the scheme of implementation or execution has been taken place or brought into the Act. And here also one more important thing is, as you know, the assessment procedure is different and the penalty procedure is different. There are 2 different mechanisms. So during the assessment, if they happen to come across the violation, then a parallel procedure of penalty also will be initiated, maybe at the parallel to the assessment procedures or after the assessment procedure. So that is the execution, how the law will be implemented, right? So with that, let's try to understand the background. Now when we talk about background to this law, so 269 SS and T, that is repayment of advance and means taking advance and repayment of advance. These provisions were brought in long time ago, sometime in 1981, and the reason why they were brought in was, so when income tax officers used to go for search scrutiny, they used to find cash with the assessee, whoever search was conducted. And when the cash was found, most common reason by the taxpayers was that it is someone's loan, or someone has given me loan, right? And as you already know, loan is a capital account transaction, and when it comes to capital, unless otherwise law prescribes it, you cannot tax. It is not a revenue transaction, it doesn't come in P&L credit side, it will go to the balance sheet. So because of this reason, a lot of taxpayers were able to escape the rigors of income tax by saying that this cash, whatever was found, was because of this loan or deposit from some person. So that's the reason why government brought in this provision to say that, okay, fine, if you receive loan or if you receive deposit, you have to receive it in a certain manner. Unless you receive it in this manner, we are going to deem that there is it is going to contravene this provision, and we are going to levy penalty. Now we are not going to worry about whether that person from whom the money has come, is it tax or not. All that is not our problem. You have to comply with this. That's the thought process behind introduction of 269 SS and T. And then after that you have ST, which was recently introduced. The main thought process behind that was, now in India only very few number of people pay income tax, maybe 2% of the population. So how do you cover the tax getting for the rest? So the best way to do that is indirect tax, GST, right? But the problem with GST is, unless the transaction comes to the knowledge, the person who's collecting the GST will not be interested to deposit. So that's the reason why government thought that, what if we bring a law wherein it mandates that whenever a person receives, okay, on the P&L front, the other laws are basically on the capital front, this is on the revenue front. So whenever a person receives, especially on the P&L front, he should receive it in a certain manner, and by that they made sure that the indirect tax revenue, whatever is getting collected by the seller, gets reported. So that's what they try to ensure. Okay, so these are the main two sections we have in this chapter, and this is the reason why they were brought in. Now, there were a lot of appeals to the Supreme Court saying that can this kind of restrictions be imposed on a particular business transaction? Is it allowed? Supreme Courts have held that the intention does not discriminate, and it is for a reason, and India is such a country where that reason is important. So because of that reason, Supreme Courts have continuously held that constitutionally the laws, whatever it was introduced, is valid and can be enforced. So that's a brief history of how this chapter works. Right? So with this, let's go to the first section, 269 SS. Mode of taking or accepting certain loans, deposits, and specified sum. So three things are there. Now specified sum is a recently introduced word. Earlier it was not there, it was introduced somewhere in 2015. The law says that no person shall take or accept from any other person, herein referred to as the depositor. So the requirement to comply with the law is on the person taking money. Okay, person, the borrower. The responsibility to comply is on the borrower. So what shall he not do? He shall basically not accept any loan, deposit, or any specified sum otherwise than by an account pay check. Okay, account pay check crossed, account pay, or account pay bank draft, DD, or use of electronic clearing system through a bank account. Okay, inter-transfer through banking system through such other electronic mode as may be prescribed. So we'll see the mode later, like NEFT, RTGS, all those things. Right? So the law mandates that the borrower, if he's borrowing, if the borrower basically, if he's taking loan, deposit. There's a difference between loan and deposit. We'll see that later. And specified sum is also different. So three different things. If he's doing it, then he should do only through these four mechanisms. And what is the limit for that. How do you calculate the limit? How do you calculate the limit? The law says that if the amount of such loan or deposit or specified sum or aggregate amount of such loan, deposit or specified sum. So each one or permutation combination of any one. Okay. Next one is on the date of taking or accepting such loan, deposit or specified sum, any loan or deposit or specified sum taken or accepted earlier by such person from the depositor is remaining unpaid. So clause 1 says that the borrower can't take unless through these channels any permutation combination of loan, deposit or specified sum, or it also says that when you are calculating the limit, you should not only consider the transaction value but you should also consider the opening balance, right? So they're saying that on the date when you take this money, on the date when you take the loan, deposit, these things, on that date whatever is remaining unpaid, that also should be considered for the purpose of calculation of the limit. And then third is the amount of aggregate amounts referred to in clause A together with the amount or aggregate amounts referred to in clause B. So the law is saying that the borrower can't take either loan or deposit or specified sum either individually or in aggregate or by adding the opening balance or unpaid amount, all these put together. He can't take. How much is the limit? The limit is 20,000 or more. Okay, so the law is restricting the borrower and forcing him to make sure that he any amount beyond 20,000 or 20,000 or more is taken through the channels like account paid check, demand draft, clearing system, or any other electronic mode like RTGS, NEFT, or this one, right? So the law is basically restricting the borrower in terms of this, right? Fine. So that is the first the provision. Now there are certain provisos to this. There are certain exclusions from this rigors. What are the exclusions? The first proviso. The first proviso says that provided that the provisions of this section shall not apply to any loan, deposit or specified sum taken or accepted from, or any loan, deposit or specified sum taken or accepted by one government, right? Like our ministries, departments, we have, so they can take cash. There is no problem. Any banking company, post office savings bank, or cooperative bank. So banking company, we all know it comes under RBI schedule. Post office and cooperative bank. Cooperative bank is basically a cooperative society but has been given a banking license and they can trade with outsiders also. So they can collect deposits from outsiders. So it's a cooperative bank. Or any corporation established by central, state or provincial act like Bangalore Electricity Corporation, BWSSB, BDA. Okay, that is the best example for that. Bangalore Development Authority, which is a corporation established under law. Any government company defined in clause 2 section 45 of Companies Act, like your Bangalore Electricity Board, BWSSB, which is a company which is owned by government. Or any other institution, association or body or class institution or bodies which may be central government made by for reason to be recorded in writing, notifying this behalf. So far nothing has been notified under this. So these class of borrowers, that is government, bank, post office, cooperative bank, or bodies established under act or government company, these are not covered under rigors. So they are allowed to take, borrow, deposit or specified sum. They are able to take these things without the limit of 20,000. The 20,000 limit doesn't apply to them, right? Next, there is second proviso to it. There is a second exception to it. What is the second exception? The second exception is with respect to agriculture. So, second proviso says that the provisions of this section, okay, shall not apply to any loan, deposit or specified sum, right? Okay, loan, deposit or specified sum where the person from whom the loan or deposit or specified sum is taken or accepted, that is the borrower, that is the lender, sorry, and the person by whom the loan, deposit or specified sum is taken, that is the borrower, are both having agricultural income and neither of them has any income chargeable to tax under this act, right? So government, understanding the practical difficulties in an agricultural economy, they know that these banking facilities etc. may not be available in rural areas, and people who do not come under the tax bracket may not have any interest in taking PAN number and all those things. So that's why they are excluding these people outside the purview of these rigors in the second proviso. But the thing here to be noted is both the person taking the deposit or the loan and the person giving both have to be both have to have agricultural income and both have to be not covered under the income tax. So that is the most important requirement under this clause. And the third proviso with effect, which is introduced with effect from 1/4/2023, is with respect to cooperative societies. So we have seen situation where it is a cooperative bank. Now, as you all understand, cooperative bank means it is a society, but they have been given banking license. So once you get banking license, you are permitted to transact with outsiders. But if you do not have banking license, then you are only allowed to transact with members. So if a person has to deposit, then he needs to be a member. Then only you are allowed to accept deposit from me or lend money to me, right? So now what happens in agriculture societies which do not have banking licenses? There are agriculture societies. These agriculture societies have members, mainly farmers. These farmers do deposit or they do take money from them, borrow. So this transaction usually used to get covered under the rigors of this section. So to make sure that it doesn't get triggered, government is saying that the limit of 20,000 shall get enhanced. Okay, the 20,000 limit shall get enhanced to rupees 2 lakhs in case of any deposit or loan. Here there is only the word used, deposit or loan. They have not used the word specified sum here. Only two things are there, loan or deposit, where such deposit or loan is accepted by a primary agricultural credit society. Okay, primary agricultural credit society or primary cooperative agriculture and rural development bank, and from its members, not anyone else, from its members, right? So the 20,000, okay, so technically these are not banks. They are not allowed to lend or borrow from outsiders. They are only allowed to do it from their members. They were getting covered through the section. Now government doesn't want to happen, so that's why 20,000 has been increased to 2 lakhs. It has been increased to 2 lakhs with effect from 1/4/2023.
This how are the societies which are there in Bangalore, whether same rule is applicable?
Technically no, because some other societies do not come under the definition of primary agriculture society, right? So there are case laws to say that you can take you can be outside the purview of this, but as per law, technically no. They have a problem with respect to this. They receive a lot of notices also with respect to this, but now the exemption is only given to this society, this kind of society, that is primary agriculture society. Now, so what are the important definitions with respect to these productions? One, banking company. We all know banking is, you have to be considered as a bank by RBI, and there's a schedule. In that schedule, if your name is appearing, then only you're considered as a bank, otherwise no. One. Second one is cooperative bank, primary agriculture credit society, primary cooperative agriculture and rural development bank. All earlier they were referring to schedule 5 of RBI Act. Now they have been linked to section 80P. In section 80P also it refers back to RBI. So these societies technically may not be a bank, but they are considered under RBI's schedule 5. Then loan or deposit means loan or deposit of money. That is also this one. It is in terms of money what is important. And specified sum. Specified sum. What do you mean by specified sum? Specified sum means any sum of money receivable, whether as advance or otherwise, in relation to transfer of an immovable property. Okay. So here, what is the important thing to note? It is related to immovable property. 1. Second, whether the transfer takes place or not. Okay, whether the transfer takes place or not, it is still considered an advance. 2. 3 is the money has to be received prior to the transaction, right? So we have case laws where we can see that wherein for the purpose of purchase, whatever money is given, that is not covered here. This is an advance towards the immovable property. This is not the sale consideration towards the immovable property. That is something which we will be very careful here. Okay, so these are the important definitions which are provided under 269 SS, right? So any doubt on this? Do you want me to clarify?
If two non-residents buy some property situated in India through any other mode, whether it is permissible?
Now, non-residents, when they have to purchase, one, there are FEMA restrictions, right? If you go to the sub-registrar, they will not register so easily. You have to have complied with all the laws. That is one. Second, when you bring in the money, okay, you can't bring in the money. You can't bring in dollars in such quantities. There's a limit on how much dollars you can bring into India. Maybe I think $2,000 or something like that in cash. You can bring in your traveler's checks, etc. But in terms of when you bring in the dollars in cash, there is a limit on that. And there is also a limitation on how much dollars you can hold in India. Residents can't hold more than $2,000 in India. So there are restrictions. It's not so easy to do it because you have some registrar who is registering the property. So he will also verify all those things. So I have not come across a situation where this has been violated in such cases. Right? So 269 SS basically says, to summarize, it says that any person borrowing from any person, loan, deposit, specified sum, has to borrow in the specified means. That is, it has to be either account paid check or demand draft or banking channel or specified modes like NEFT and RTGS if they are borrowing 20,000 or more. That is the law. And any permutation combination and surprise, I mean, the important thing you need to notice here is you have, when you calculate the 20,000, it's not only the money what you're borrowing matters, but also the opening balance what you have, the unpaid amount whatever you have, that also should be considered for the purpose of calculating 20,000. Right? So that is with respect to 269 SS. Now,
These are NEFT and RTGS. What about things like Google Pay?
that is also covered. The next one is that one. So, what is the modes, other modes? What the law has prescribed is, we have to refer to Rule 6 ABBA, where it says that other electronic modes is 1, credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT and BHIM. Aadhaar. So all these modes have been prescribed wherein, so through these modes you can take loan, take deposit or take specified sum from the borrower. So these are all the other modes.
Wallet also.
So
Wallet,
payment wallet.
Paytm wallet.
But I think Paytm wallet also has a limit, right? I don't think so you can transfer more than 20,000 or something in that. Wallet transactions are limited. If it is UPI, they allow it.
UPI is covered here.
Covered.
Wallet.
But I don't think so you can transfer so much money also in wallet. Next. So now the situation is you have now borrowed, right? Now the borrower has to repay. If it is loan, they have to give back the loan borrowed. If it is deposit, then with the interest, they have to whenever someone asks, they have to give it back, right? So now, what happens in case of repayment? Can repayment happen in any mode? The answer is no. For repayments also, there are restrictions. So the law says that it is covered in 269T. No branch of banking company, a cooperative bank, and no other company or cooperative society, and no firm or other person, okay, shall repay any loan, deposit, any specified advance received by it, otherwise than by account pay check, account pay bank draft in the name of the person who has made the loan, deposit or paid the specified advance, or by using electronic clearing system through a bank account or through such other electronic mode as may be prescribed. Okay, the same set of 4 requirements whatever there in the 269 SS, the same has been carried forward. However, in this, the additional thing what they have mentioned here is with respect to demand draft, where they say that it has to be in the same person's name who has given the deposit. Then here, how do you calculate the limit? The limit is if the amount of loan, deposit or specified advance together with interest, if any, payable thereon. Okay, so individually, okay, then aggregate amount of loans, deposits held by the person with the branch, banking company, cooperative bank, or as the case may be, other company, cooperative society, or the firm or other persons, either in his own name or jointly with any other person, on the date of such repayment together with interest, if any, payable on such loans or deposits, right? So this is with respect to your opening balance, okay, whatever opening balance which is repayable back. The aggregate amount of the specified advance received by such person, either in his own name, jointly with any other person, on the date of such repayment together with interest, if any, payable on such specified advance, right? So it is permutation of combination of everything, all the loans, deposit or this one, including the opening balance. So just to make it easier to remember. So all these things combined should not be 20,000 or more. If it is 20,000 or more, then you have to take it in the specified manner, otherwise penalty will be invoked. Now similar to exceptions what we had in borrowing, that is we have exceptions with respect to agriculture, or we have exceptions with respect to the government company, all those things. We also do have similar exceptions in case of repayment, right? So when borrowing is also, there are some exceptions for borrowing. At the same time, repayment is also, there are some exceptions to the repayment also. So what are the exceptions? The first proviso says that where the repayment is by branch of a banking company or a cooperative bank. Okay, so one is banking and then cooperative bank. such repayment may also be made by crediting the amount of such loan or deposit to the savings bank account or current account, if any, with such branch of person to whom such loan or deposit has to be repaid. So through your banking channels, you can credit and debit to the savings account or current account that is outside the purview of 269T. Second proviso is exactly same like how we had with respect to 269SS, wherein the repayment, the provisions for repayment do not apply to one government, banking company, post office, savings bank, cooperative bank, any corporation established by central, state, provincial act, any government company as defined in section so and so, and whatever is notified. So far nothing has been notified. So the same exceptions what we had there to 269SS is here. Now we don't have the same exceptions like agriculture is not there here. So that is one of the differences between SS and T. Then third proviso we have. Third proviso which introduced with effect from 1/4/2023. The limit of 20,000 shall get enhanced to 2 lakhs. Same cooperative societies, what agriculture cooperative societies exemption we had is also given to repayment also, where it says that 20,000 shall be enhanced to 2 lakhs in case of any deposit or loan, not with respect to specified sum, only deposit or loan, where such deposit or loan is accepted by primary agriculture credit society or primary cooperative agriculture and rural development bank from its members, right? So this is with respect to repayment, and here same definitions whatever we had in SS is also same thing is here. There are only one difference that is with respect to loan or deposit. The definition there is pretty simple, but the definition here is pretty elaborate. It says that loan or deposit means any loan or deposit of money which is repayable after notice or repayable after a period, and in the case of a person other than a company includes loan or deposit of any nature. Okay, so there it was very simple, that is loan or deposit of money, but here they are telling that it is repayable once there is a notice, etc., etc. So that is with respect to 269T. So now with respect to these two sections, one is borrowing and then one is repayment, we have various situations or practical scenarios, and we know how the law has been interpreted by the courts. So we'll see these situations one by one. Now what is the most common thing what I have come across here is, earlier, that is when the law was introduced, when the courts were interpreting the provisions, they were interpreting it with some kind of reasonableness, as in they were saying that 269 SS and T doesn't apply if there is no mens rea. Okay, they used to say it doesn't apply itself. But now the way the courts have interpreted is, they don't go by your intention, they go by the facts, and they say that if the conditions are triggered, then the law applies, then reasonableness will come into picture. So there is a slight difference between how the law were to be interpreted before and the law is being interpreted in current scenario, right? So we will see a case law to support that. So first one is, we will see Samora Hotels. So in this case, the transaction is between a company and the directors. The transaction is between a company and the directors. So this is earlier, what used to happen before. Okay. So so I will read this. Section 2, this is the observation by the court. Section 269 SS prohibits a person from taking or accepting from any other person any loan or deposit. The assessee being a juristic person would be covered by the said provision. there is no dispute with this. Expression any other person in section 216 SS does not exclude directors or members of the company which have received or accepted loan or deposit. So now the law is interpreting, saying that when you say borrower, company is different and the directors are different. Any borrower by the company from the directors would trigger 269 SS, right? Now see a situation how the interpretation used to happen before. Both the assessee and the directors were on the record of the income tax department and both declared these transactions to the department. Chapter 20B and section 216 SS begins with the heading requirement as to mode of acceptance, payment or repayment in certain cases to counteract evasion of tax. The term certain used therein when read along with the legislative intent of curbing tax evasion clearly means that all loans are not attracted. This section is definitely not intended to penalize genuine transactions. Where no tax evasion is involved, thus the transactions between assessee and P did not fall within the mischief sought to be remedied by the section, as there was no case against the assessee and these transactions had anything to do with the evasion of tax or concealment of income. So there are case laws which are for and against on the same issue, and the way it is interpreted earlier and the way it is being interpreted currently, you can see the difference. Earlier, intent used to drive whether the section applies or not. Now it is not driven by intent, but now it is more driven by action. It is more like a 1 + 1 is 2 in this current situation, right? So going as in, what I would advise is, whenever any client is entering into this sort of transaction, they may have a reasonable cause. They may have a reasonable clause, but the section technically applies, and reasonable cause have to be proved to get come out of the provision. But the same was not in the earlier circumstance, right? That is so these two case laws talks about the relationship between a director and a company, and the company taking unsecured loans from the directors. Next, deposit, right? Now there's a slight difference between deposit and loan. Loan and deposit are not the same. In case of deposit, there is an intention from the person giving. In case of a loan, there is an intention from the person taking. In case of a deposit, the person has to give back within certain this one. As in, I am giving a deposit with the intention to receive with certain conditions. But in terms of a loan, that responsibility is cast on the person repaying. So there are two different transactions, and they have been explained by the courts also. So in case of a deposit, the essence of a deposit is that there must be a liability to return it to the party by whom or on whose behalf it is made on fulfillment of certain condition. When you talk about loans, the term loan generally refers to borrowing something, specifically a sum of cash that is to be paid back along with interest decided mutually between the parties. In other terms, the debtor is under a liability to pay back the principal amount along with agreed rate of interest within a stipulated time. So that is with respect to loan. Now, the reason why we need to understand deposit or loan, the reason is, whenever we are transacting in day-to-day this one, we come across a lot of situations. Situations like, let's say I have sold some machine. I sold some machine to you. You have not given back the the money towards the machine. Now, the money which I have not received from you for selling the machine, what is the status of that? Does that transaction get covered under 269 SS? Does that become a loan? Does that become a deposit? What do you think? Does it become? Basically, unpaid amount towards my sales. Does it become a loan? Does it become a deposit? No, right? So that is the difference what we need to appreciate in this. So we should not apply 269 SS and T. The reason why this also has importance here is we have tax audit reporting. Okay, we have 3CD. In 3CD, there are clauses in 3CD to report about 269 SS, T and ST. So whatever we understand or how we interpret these sections has bearing on those reportings also. If you think it has to be reported, if it falls under this section, then you have to report it under 3CD. So that's the reason why interpreting it is very, very important, and that's the reason why you need to understand the meaning of deposit or a loan. Okay, so intention is what really matters. So any unpaid amount, etc., doesn't come under the definition of deposit or loan. To support that, we have a case wherein Saurashtra Cements, the amount of unpaid price on plant and machinery supplied by a non-resident cannot be said to be a loan advanced by the non-resident to the buyer, nor can be the non-resident be said to be the lender to the buyer so far as amount was concerned. So that is very, very important to understand, right? Next, any doubts so far?
Any example I want, not understood, deposit and loans, any example?
So here when you say deposit, you are interested to get something in return, and that whatever you want to get in return is something related to money. You have not given anything. Like for example, you have rendered service and you have to get back. Now it is, you have given something, you have got back. In deposit, that's not the case. In deposit, you are giving money, you want to get back money with an element of interest. That is deposit. So understanding deposit as compared to a commercial transaction is very, very important, because let's assume you have rendered a service. Now they don't give you back the money. Now do you consider them as do you consider them as borrowers? So if you consider them as borrowers, do you report these transactions under 269 SS and T? Okay, so and the amount of 20,000. Now let's say you have given them the loan. Now if you interpret it as loan, now if you have given them the loan, does it come under any of the clauses? So should you worry about that? So all these things will come into picture when you talk about this. So that's the reason why understanding deposit versus regular commercial transactions is very, very important with respect to 269 SS and T. Right? The same thing happens with loan also. So when I borrow, I have an intention to repay it. In terms of a deposit, I have an intention to give and get back. Here I want it, I'll give it to back. So that's the main difference between deposit and loan and other commercial transactions. Now 269 SS and undisclosed incomes. So now practically what happens is, let's assume there's a search which happens and there is some cash which is found. And first, let's say you want to contest saying that it is someone has given me that loan, but later on you accept that that is your income, and then you are ready to pay tax on that. Okay, you accept that it is your income and ready to pay tax on that. Now let's assume the assessing officer also agrees with you, and then he goes ahead and treats it as your income and then taxes it. Now what have you done first? First you said that it is loan, and then you accepted that it is income. Now, can the assessing officer in this case, initiate both the proceedings? That is, one, can he treat it as income? At the same time, can he levy penalty on you for saying that it is loan? Can he do that? What do you think? He cannot do, right? So that's what the courts have held in many occasions, wherein once you have accepted that something is income, it cannot come into the balance sheet. It cannot be treated as deposit, loan, or specified sum. So in case of Diwan Enterprises, that's what the court said, that the record of the proceedings showed that the assessing officer had discarded the theory of assessee having taken any loan. He accepted the surrender of amount as income of assessee. The assessing officer could not be permitted to treat the amount of loan as income for the purpose of section 269 SS, read with section 271D. 271D is the penalty section which will get triggered because of contravention of 269 SS. Right? So, the assessing officer, if he treats that loan, if he treats it as loan, then only he can invoke the penalty provisions. If he treats it as income, then he cannot invoke the provisions of penalty. He doesn't have authority to basically double tax the same transaction under two different, either one is P&L account and one more in balance sheet. He can't do that. Okay. Next, similarly, now we saw a situation where income was offered to tax. In this case, though, what happens here is they found cash and they taxed it under section 68, that is cash credit, undisclosed cash credits. So what happens in those cases? There is a flat tax there. There is no deduction given against that whatever you declare, right? What happens in this circumstance? So once certain amount, okay, Young Men Christian Association, that's the case law. So once certain amount was subjected to tax under section 68, question of treating it as transaction in violation of 269 SS did not arise, as it stood mutually excluded, right? So not only that you are treating it as income, that is one situation. Second one is you don't treat it as income, you treat it as undisclosed income and tax it flat rate. That there also you have exclusion. So one transaction can only have one ramification based on these cases, right? Then, now in practical scenario, we have a lot of cases wherein we have agents, okay? We have agents who go and collect it on someone's behalf, okay? So what happens in those cases? Can the money collected by an agent, can it be considered as a violation of 269 SS? Okay? If you say that whatever the money has been collected by an agent, if it is a deposit or if it is a loan collected by him on someone else's behalf, then it will get triggered. For example, I am going on your behalf, I am collecting the money from your this one. So whenever I collect, I have to pay back to you, right? So it's technically that I have borrowed money from you. Is that the way you have to interpret? Or when I am an agent collecting on your behalf, technically it is your money I am collecting and I don't have any authority over the money. It's not the money which I have to repay to you, it is your money. How do you interpret it? How do you interpret an agency situation? Do you interpret that the money belongs to the agent and he has to give it back to the principal? Or do you interpret that money is principal's and I am just holding it only intermittently? What do you think? Option 1 or option 2? Option 2. So if you interpret the fact that whatever money has been collected by me has been held only intermediately for, and I have to give it to the principal, then that money doesn't take the shape of deposit, loan or specified sum. It doesn't take the shape of that, right? Once it doesn't take, the rigors of this cash, whatever I am borrowing, doesn't get attracted in this situation, right? So let's see that. When a kacha arhatiya means it's a person, it's a commission agent actually, sells goods belonging to agriculturists. The sale proceeds thereof which remain with him cannot be regarded as deposits made by agriculturists with the agent within the meaning of 269 SS. So when an agent collects, it doesn't trigger the rigors of 269 SS. And then when he repays also, the same provisions do not get triggered because agent is acting on behalf of the principal, right? But at the same time, the board circular which gives this relief also says that if the money collected is not for the purpose of the principal, then whatever you collected will take the shape of deposit. So, however, going further, board circular, however, such unremitted amount sale proceeds would assume the character of a deposit if the amount is retained by the agent in pursuance of direction in this regard by the agriculturist. If the agriculturist says that don't pay me, you keep the deposit, then it will take the shape of deposit, irrespective of whether the amount is retained in the same account or transferred to different accounts, and irrespective of whether the direction are to call it a deposit or just to retain the same amount for future payments. The repayments in such case would be covered under section 269D of the Act. So, if the agriculturist were to specifically mention that the money which he has collected, it should be kept as deposit, then these sections will get triggered, but otherwise these sections will not get triggered in the case of agency conditions. Okay. Similarly, trade advances. So I want to buy something, I have given something in advance, right? I have given, let's say, 2 lakhs, 5 lakhs in advance. Whether trade advances, do they get covered under 269 SS and T? The answer is no, because it doesn't come under the definition of loan or deposit. I am not giving this money with intention to get back money. I am giving this money with the intention to get back the product, right? So it doesn't get covered under the section, under the definition of loan or deposit, right? Next, immovable property. Now, any advance received with respect to the immovable property, we saw that it will trigger section 269 SS and T, correct? Now, does the fact that the advance, whatever you received towards immovable property, you have it as closing stock or you have it as capital asset, does it make any difference for 269 SS or T? Does it make any difference? Whether are you in business, are you not in business, does it make any difference? Does it make? The answer is no. For 269 SS and T, the fact that you have received advance for immovable property, only that is relevant. Now, whether that is a closing stock, whether that is a capital asset, okay, whether are you in business, whether you are not in business, it doesn't really matter. It doesn't really matter as long as the advance is related to the immovable property and it is earlier to the transaction. It is earlier to the transaction. The sale may get cancelled. It doesn't matter, but it should be related to the immovable property, right? So with respect to this specifically, that it has to be before the transaction, we have a unique case law. We'll see that. Ram Kumar Reddy, okay? that the sum specified as per explanation to section 269 SS of the Act would be applicable only for advance receivable, namely as advance or otherwise. Means advance can be in any manner, and therefore this provision will not apply to the transaction that happens when the final payment at the time of registration of sale deed. Okay, so now because of the introduction of 269 ST, we may have a problem, but earlier to introduction of 269 ST, where cash receipts beyond 2 lakhs you are allowed to take it, then this section would have actually helped, this case law would have helped us in case you want to take some, in case the assessee, let's say, would have taken some cash at the time of sale. Okay, there was no barring until the introduction of ST. Okay, so are we clear on this case law? Do you want me to explain? Right. Then share application money. Right. Now share application money. Do you think this share? So let's say I am the shareholder, means I am the prospective shareholder, and the company is there. I want to subscribe to the shares of the company. I pay 1,000 rupees to the company. Does it take the shape of loan, deposit, or specified sum? Answer is no. Even though I may be giving some money, and they might not have allotted shares to me, but still it doesn't take the shape, because here my intention is never to get back money. My intention is to get back the shares. So there is a clear difference between me giving share application money versus me giving deposit. Right? So share application money was neither a loan nor a deposit, and provisions of section 269 SS would not attract, and no penalty could be levied. No penalty could be levied. Now, so that is with respect to share application. Next, in our day-to-day transaction, there are so many situations where we create book entries as payable, as receivable, loan, all those transactions we create. Now, when we create book entries, technically it doesn't come under the specified scheme of receipts or specified scheme of repayments. So how does the law interpret it? How does the law interpret? Do you think section 269 SS and T should get triggered because of book entries? The answer is no. So object of section 269 SS is to prevent transactions in currency. Prevent transactions in currency. It is not intended to affect cases where a debt or a liability arises on account of book entries. It doesn't affect because of book entries. Okay? So that is something which we need to keep in mind. Next. Now we come across situations wherein there are partnership firms, and in case of a partnership firm, there is the firm and there is the partner, and to incorporate or to run the business, generally the partner would automatically obviously would always pump in the money to the partnership firm to carry out the business. Now in several cases the partner might have given cash to the partnership firm to start the business. Now whether this transaction, because partnership firm is a separate legal entity for the purpose of income tax, not for the purpose of law, but is a separate entity, and the partner is a separate entity, does section 269 SS T get triggered in this case? What do you think? Does it get triggered? Answer is no. Because what am I giving? I am not giving loan or deposit. I am giving capital. My intention is not to get back the money. My intention is to carry on the business. So here, because of this reason, there case laws have held that the transaction between partners and partnership firms do not get covered under SS and T. So the provision of 269 SS would not be violated when money is exchanged inter-se between partners and partnership firm, in spite of the fact that the partnership firm and the individual partners are separate associates, right? So that is with respect to partners.
These people only at the time of infusion of capital or even payment of remuneration or whatever?
So when you infuse capital, it is a capital transaction. Remuneration payment is a a revenue transaction. So revenue transaction do not per se come into this. It is only the capital transactions which will come into this. So technically remuneration, there is no problem with respect to 269 SSNT.
Cash can be paid.
Cash can be paid. You have your 40A, there it may get triggered, but this section doesn't get triggered. Next, reimbursements. Now, what happens in most of the cases, practical cases, is, let's say I am visiting let's say a construction site. There some expense happens to come across and I happen to pay and I get reimbursement from the company. Okay, so there is no possibility for me to get the money from them and then pay. The time may not be there to do all those things. So you pay and then you can take reimbursements. Now whether the reimbursement means what money you have paid on behalf of the company. Okay, does it get covered under 269 SSNT? What do you think? Does it get covered? The answer is no, because the transaction, that is on behalf payments, what you have carried on behalf payment, what you have carried on, okay, it was never with an intention to give loan or deposit. That was never the intention. It was basically it was a business emergency. You happen to pay on behalf of someone for a business emergency, right? So because of that, case laws have held that expenditure incurred by assessee hostel, which was reimbursed by managing trustee of school, would not be treated as deposit or loan so as to attract section 269 SS. Okay, so reimbursement transactions are also outside the purview of 269 SS and T. Then retention. So we know that once we have given contract to some contractor, every bill we may retain 10%. Some companies have this procedure, mainly government entities have this procedure wherein they retain certain percentage. Now, whatever you retain, does it take the shape of loan from the contractor? Does it take the shape of the loan from the contractor is the question. If it takes the shape of the loan from the contractor, then we have to report it. Otherwise, we don't have to report it. What do you think? It doesn't take, right? So ICAI has also given means in its tax audit guidance, they have clearly given that whatever the retention money retained by the means on behalf of the contractor doesn't get covered under section 269 SS. So whether a deposit as per para 39C of AS 7 construction contract aforesaid amounts as retention, thus it is not really correct to call security thus it is not really correct to call these security deposits. These are retention, so withholding amounts out of contractor bills and releasing them after warranty period does not attract the rigors of actually 269 SS and T. So for the purpose of your 3CD reporting etc., you can rely on these things and you don't have to report these transactions. Then, transaction between closely related persons. Okay? So, as we discussed, in earlier instances, the way the courts used to interpret 269 SS was that intent was the main criteria, even to attract 269 SS and T. So, there are some case laws, okay, which have been delivered, which says that 269 SS and T doesn't apply to transaction between close relatives. It doesn't apply to transaction between close relatives. Technically, In current situation, it might not hold water, but there are case laws. In case someone has to come across this situation, they can use these case laws, which says that 269 SS is applicable only when assessee accepts the loan from any other person. In context of 269 SS, any other person does not include closely related persons. Okay, so these have been colorable words which the courts have interpreted, but you can use in case of any issues you come across. Similarly, convertible debenture security subscription. What do you think? Convertible debenture security subscription, is it a loan? And if it is not a loan, what is it? It is a loan? Okay. Whenever there is an element of convertibility, these instruments are treated as hybrid instruments. Okay, for compliance of FEMA also, these instruments are treated as equity actually. So courts have interpreted that whenever there is hybrid instruments, they take the shape of equity. And whatever money you are given for subscription, whatever money you are given towards a subscription is outside the purview of 269 SSNT, because it is not loan, but it is technically equity. So when assessee received certain amount by way of subscription money for allotment of debenture under optionally fully convertible debenture scheme, the subscription collected under said scheme was neither loan nor deposit within the meaning of section 269 SS. Right? So because it was a hybrid instrument, and there was a doubt on repayment, okay, what could happen after 3 years is, instead of paying back the interest, they can convert it into equity. So because that option was there, the instrument was interpreted as equity instrument for the purpose of 269 SS. Right? Next, bailment. What do you mean by bailment? Is, let's assume I'm traveling and I happen to stay in a hotel, and then I have some currency. I am not comfortable keeping the currency in my room. I happen to give the currency to the travel desk or the hotel desk and tell that you keep this with you, and then you give it back to me when I want it. Now in this situation, what will happen? Whether this transaction, okay, I give the currency and I get it back, does this get covered under 269 SS? Because when I give it, it is technically the hotel borrowing it. Do you think it is a loan? Do you think it is a loan or no? No? Possible? There are two options to this. The two options is, one, when I give you currency, you maintain the same currency, you give it back to me, it will become bailment. There is no, you don't change the nature of the transaction. Plus, this transaction doesn't get accounted in the books of accounts. However, there are some situations where when I give you, you record it in the books of accounts and you will give it back to me in a different currency or a different mode. So these transactions do not come under bailment. So what do you mean by bailment? You are holding something. For you to take it back. So those transactions are outside the purview of 269 SSNT. But if you take the currency and then you happen to give it in different currency or change the different exchange rate, then that will come under 269 SSNT. Right? So if A pays money to B, who agrees to return not the identical currency in spice but an equivalent sum, subsequently no bailment arises but simply a loan owing by B to A. The fact that it is called a deposit can make no difference. So if you give it in a different currency, you convert it and give it to it, then it will come under the definition of loan. If you give it in the same currency without changing any nature of the money whatever you accepted, then it will be outside the purview of 269 SS and next, cross check, right? So the law mandates that when we borrow or when we repay, it has to be crossed account pay check. It has to be crossed account pay checks. So technically, you have to cross it and then write account pay. It will get deposited to the whoever you have given, right? To his own account it will get deposited. No one else can use it. Now there are some instances wherein businessmen have not written the word account pay. They have crossed it, but they have not written the word account pay. But the money has got deposited in the same person. It has got deposited into the same account. Okay, there is. So now, technically, there is a contravention because the check is not written. It is crossed, but account pay is not written. But the intention is satisfied, wherein it has gone and got deposited to the same person. Now, what will happen in these circumstances? Do you think penalty should get triggered or not? Right? So we have several case laws to say that penalty should not get triggered in these circumstances, and it should be it is not a violation of 269 SS. So if the check or bank draft through which loan is received is crossed, but words account pay is not written in the crossing, but the transaction is otherwise genuine, and the bank confirms that these amounts have been deposited in assessee's account and are as per the banking norms, and there was no flaw in the transaction, penalty under section 271D is not imposable for such trivial violation.
So what is the difference between cross check and account pay check?
So cross check means you can encash it in cash. In account pay check, it will get deposited to your account. So like
So you mean that bearer is not
Cross check can be without account pay, without or with account pay. You can just even cross check. It goes to account pay. You cannot encash it. If you make account pay, it becomes more secure.
it will get deposited to your own account. That is account pay. If you don't write account pay, you just cross it. You can only use it.
It's a bearer check then.
It is not a bearer check. If you cross it, it is not a bearer check. If you don't cross it, it is a bearer check. If you cross it, then you can take cash also for that. As in, you only have to go, but you can take cash for that.
Directly.
Yeah, you can take cash. Only you can take cash. No one else can take cash. In bearer's check, anyone can do it. In cross, only you can take. In account pay, they will not give you cash. They will deposit to your account only. So that's the here with respect to cross check. Next, cash deposited into bank. Okay, in several instances, technically it is a violation, but courts have held that if you deposit the cash and it has gone to the right person, everything is recorded correctly, penalty is not leviable. But technically it is not under the situation of 269 SS, but you can use these case laws in case you have practical scenarios, right? So no disallowance if cash exceeding 20,000 is directly deposited into the bank account of the supplier. It's just a reference case law, not directly on the 269 SS, but you can use these case laws. Next, similarly, we discussed about societies, credit society, credit cooperative societies, especially let's say non-agricultural. What happens in those cases? In those cases, presently, I have seen situations where they take more than 20,000 cash, everything, they do like a regular bank. What happens in those cases? So, we have a case law with respect to that, citizen cooperative, so we'll see that. If the assessee society, whose income is exempt under section 80P, acted on genuine belief that penal provisions had no application to deposits received by it, and it applied only to other kind of assessees, then there existed reasonable cause in accepting the deposit in cash and paying by cash in violation of section 269 SSNT, and the assessee may therefore be exonerated from levy of penalty under section 271D and 271E. Okay, so presently in my knowledge lot of societies actually undergo these problems, and you can actually refer these case laws in case of such issue, because after the government has made changes to made changes to the society and they have increased it to 2 lakhs, the chance that other societies will come under the scrutiny of income tax actually has increased, because now there was no question of there was no word society used in the 269 SS. Now they have identified societies and they have given them a higher level. Now societies which do not come under that definition of society, what will happen to them is something which is very debatable, and these case laws actually help them. Right? Next, now is on loan is payment of interest mandatory? Can there be interest-free loans? Yes, there can be interest-free loans. It is not mandatory that you should have you should always charge interest with respect to this. Next, proprietorship concerns. So there is a proprietor, there is a proprietorship concern. Proprietor is contributing to the proprietorship. Okay, capital. Does it come under 269 SSNT? Answer is no. It is the same person. It is not 2 different person. So that's the reason why it will come out of the provisions of 269 SSNT. Right? So these are some of the common issues what we come across in 269 SSNT. So any doubts, any points you need to clarify, please let me know.
The proprietor, he borrowed some 20 lakhs to buy the land, then it is not covered.
So proprietorship because it is the same person. There is no 2 different this one. This section doesn't get triggered because of
He
that.
borrowed some 20 lakhs loan from outsiders.
From outsiders. Now that will get covered because proprietorship is different, outsiders are different. So that will get covered. But his own money he is introducing, or he is the capital drawings, he is drawing from the concern, then no problem. Okay. Let's go to the next concept, that is ST, 269 ST. Now 269 ST is also, it's a recently introduced provision and mainly brought in to make sure that the revenue transactions, whatever the revenue transactions are being conducted mainly, are covered under banking channels, and because of that your indirect tax collections are secure in terms of government. So here the law says that no person shall receive an amount of 2 lakh or more, okay, 2 lakh or more in aggregate from a person in a day. Here a person 1 day in respect of single transaction, or in respect of single transaction. Okay, it can be from any person, but it should be with respect to one transaction, or in respect of transactions relating to one event or occasion from a person. Okay, so first we have a person, a day, then we have a single transaction. It can be from any person but with respect to single transaction. And next, third one is you have one event and a person. So these are the 3 circumstances which we need to consider while applying 269 ST. Right? So you can't receive 2 lakhs or more in these circumstances otherwise by an account payee check, an account payee bank draft, or use of electronic clearing systems, through a bank account or through such other electronic mode as may be prescribed. Okay, law has prescribed the electronic modes like your debit card, credit card, all those things which we have discussed. So these are the ways in which you have to receive 2 lakh or more. There are some exceptions to this rule. What are the exceptions? The first exception is the provisions of this section shall not apply to any receipt by government. So government can receive more than 2 lakhs in any mode, or any banking company, post office savings bank or cooperative bank. So these people can receive, there is no restrictions. Now similar to SS, government company or corporations created under the law, these are not included here. So here it is only limited to banking, post office, cooperative bank. Even society is also not mentioned here. Then the exception goes on to say that if a transaction is covered under 269 SS, then it will get excluded here. What is covered under 269 SS? It is a capital transaction 20,000 limit. Here it is 2 lakhs other than capital transaction technically. Okay, so that is how you interpret it. And then such other person or cases of person as may be specified. There was one specification at one point in time, but nothing else has been specified after that. During COVID time, something else was specified. We'll see that later. So this is the section. Okay, there is the person receiving is stopped. Okay, so you can't receive. The penalty is on the person receiving. Okay, you can't receive more than 2 lakh or more. So how does the clauses work? How does each situation work? A person, 1 day. So the first clause states that the amount of 2 lakhs or more cannot be received. Amount of 2 lakhs or more cannot be received by a person in a day. Irrespective of the number of transactions, it doesn't matter. Okay, irrespective of the events, it doesn't matter. But 1 day, 1 person. Therefore, the prerequisite for applicability is there is a single payer, there is a single receiver. The amount of cash paid in a day is 2 lakhs or more. The amount paid is in a single day. So all these conditions have to be satisfied. If these conditions are satisfied, you can't take more than 2 lakh or more. What is common across all the 3 conditions is the recipient. The recipient is only one. But the payer, the person giving the money, sometimes is one, sometimes it is multiple. Both, that is also possible. So that is something which you need to keep in mind. But in this situation, 1 person, 1 day. That is the limit. For attracting the first clause, it does not matter how many transactions there are between the receiver and payer. Okay, number of transactions are not important here. Here it is 1 day, 1 person is important. Okay. So there are some examples which I have given. So we will see, let's say example number 4. If Mr. X receives 1 lakh from Mr. Y and also receives 1 lakh from Mr. Z in a day, and transaction with X and Y is not a single joint transaction, then there is no violation. So 2 different people are paying. 2 different people are paying, so there is no problem. Right? Next, here it is with respect to a transaction. It is a transaction. Any number of days, doesn't matter, it is single transaction. So the prerequisites are: 1, there is a single payer or multiple payers. So for 1 transaction there can be multiple payers also. Let's say you are going to buy jewelry, mother pays and daughter pays. Okay, but it is 1 jewelry or 1 invoice what you are purchasing. There is a single receiver. There is 1 transaction to which the payment relates. The total amount of cash paid whether in one day or multiple days adds to 2 lakhs or more. Okay, so this is with respect to a single transaction. For attracting the second clause, following does not matter, that is number of persons, it does not matter, it can be more than one person. Number of days also doesn't matter, it can be over the period of 5 days, 10 days, it doesn't matter. This limit will work simultaneously with the limit of aggregate receipt per day from a single entity, right? So you have to read all the clauses together. Just because it passes this test, that doesn't mean that penalty will not be levied. You have to pass all the 3 tests, that is single person, single day, one transaction, any person, any day, and then one event, one person. So all the 3 circumstances have to be satisfied. Okay, if you fail in any of the any other circumstance, then penalty can be triggered. So, and also one more thing you need to note here is, let's say that transaction, the jewelry is for, let's say 3 lakhs. The jewelry is for 3 lakhs. Let's say you are buying a pendant 3 lakhs. Now you are paying 2 lakhs in bank, 1 lakh in card. Now for the purpose of this section, what matters? Is it the 3 lakhs matters? Does 1 lakh matter? Or does 2 lakh also matter? What is relevant for us? Does the transaction value matter to us, or is it the cash in the transaction which matters to us?
Cash.
It is only the cash. So when we say the pendant may be, let's say 3 lakhs, but for us what is relevant is how much cash related to the transaction is important to us. How much is the cash which is how much is the cash which is received, that is what matters to us. The transaction value may be 10 lakhs, so that doesn't matter to us. So Mr. we'll take an example here. Mr. A sells goods to Mr. B through a single bill for 3 lakhs. Then the amount below rupees 2 lakhs can be received by A from B in cash. The balance amount will have to be received through account pay check or banking channel only. If the bill amount is above the ceiling limit, 2 lakh or more, the payee cannot receive cash amount of 2 lakh or more. Okay, so that is something which we need to appreciate here. It is with respect to a transaction. Then event. Now what do you mean by event? Is a transaction event, or an event is a transaction? How do you interpret it? How do you interpret an event? Event is a bigger, is it a combination of multiple transactions, or event can also be a single transaction? What do you think? Now government is smart enough not to define what is an event. Event can be
without a transaction. Without a transaction.
Can be without a transaction also. So they have given a lot of leeway to it. So they will they will interpret it the way they want to during the assessment stage. So, but practically speaking, event generally is a culmination of multiple transactions. Generally, it is a culmination of multiple transactions. So sometimes you can split the event into multiple parts. So they want to accumulate it and then say that it is a single this one. So that's the reason why they have brought it. Best example is, let's say during marriage you have flower, you have cameraman, this one, but everything is single event. You only get married once, as in not like that, but that one marriage is one event is what I'm trying to say. Okay, so that is the way we have to interpret an event. The prerequisites for applicability of the provisions are: 1, there is a single payer, right? There is a single payer. In the case of B, there can be multiple payers, but here it is only single payer. There is a single receiver. Receiver is common across all the three clauses. There is one single event or occasion to which the transaction relates. These transactions may have spread over one or several days. Okay, so that may be, so all these prerequisites are necessary to apply this. So for attracting the third clause, number of transactions or number of days do not matter. Okay. The limit is also simultaneous, that is, each transaction you have to pass through all the three tests, that is clause A, B, C, you have to pass through all the three tests, and then only you have to see whether penalty is leviable or not. Okay, and as we discussed, event is not defined by law, so event generally or event or occasion generally means it is a culmination of multiple transactions. So we'll take an example for this. If a person has done work for of different nature in a marriage of his customers, providing services such as giving garden on rent for marriage reception, florist services, services of decoration, and has issued 3 different bills of 1.5 lakhs each for each separate service, totaling to 4.5 lakhs, he can receive amount below rupees 2 lakhs from his customer in cash, etc. mode in respect of all the 3 bills. All the 3 bills, because it is an event. It is an event. If entire 4.5 lakhs are taken in cash, then even though the limit per transaction, okay, that is clause 2, and also limit per day, per entry is not crossed, clause 1, but since all the transactions are related to a single occasion of marriage, the total limit of less than 2 lakhs will have to consolidate limit for all the related transactions. Right? So that's how you interpret the third clause in 269 ST.
So in this case, gift is issued by right? What to do?
That is something which we have to find out in case clause. But as of now, there are no decisions on that. So for example, gift received during marriage, otherwise gift received, let's say father giving to son, he is giving cash, what happens? Even though the base transaction is exempt from tax, now this law is coming and then saying that there's a penalty for that. Now, how is it possible? We still have to find out from case law. So far, no decision has come on those. Anyway, we will discuss that also. To summarize 269 ST, so we have 3 clauses and the tests for each clause is given. One is, first one, clause A, it is number of persons 1, number of day 1. Then test 2 is number of transaction 1, and test for clause 3 is number of person 1, number of event is 1. So that is very, very important with respect to 269 ST. Next. So under 269 ST, when the law was introduced, there were a lot of clarifications which was given by government, basically to make sure that law is smoothly implemented in this one. So government has exempted a lot of cases from application of 269 ST. Basically, there is a recipient taking cash, 2 lakhs or more is happening in a single day, all the conditions are getting satisfied, but it is outside the purview of 269 ST. What are the situations? One is business correspondent, right? Business correspondent means he is a representative of bank. He goes, generally in rural areas, he goes, collects deposit from a lot of people, pools it, gives it back to the bank. So something like that happens. That business correspondent is basically collecting cash, right? So he will get triggered under 269 ST. So that's why law is saying, let's exempt him also from rigors of this section. Next, white label automated teller machine operator. He's going to different businesses, collecting cash, depositing with the bank. Same case, agency situation. So that is also outside the purview of ST. Then receipt from an agent by an issuer of prepaid payment instruments. So similar to like you have your credit card collection agency, etc. So you're collecting and depositing with bank. Company or institution issuing credit cards, so they are also collecting. And receipt which is not includable in the total income under section 1070A, awards and rewards. So any of these situations, and then the recipient is taking cash, it is outside the purview of 269 ST. Now similarly, after that there is one more exemption notification which says that now the bank which is collecting cash, they are outside the purview of ST. Okay? Now you go to the bank and you collect cash from bank. Will you come under the provisions of ST? Technically yes. So that's why there is an exclusion for that. They are saying that through notification 28/2070, recipient by any person, receipt from any person from an entity referred to in clause so and so, that is any bank, post office, etc., is outside the purview of ST. Okay, bank is also outside. From them, whoever receiving, they are also outside. Then you have NBFCs. Now, when you say NBFCs, these are not technically banks. They don't have banking license. They can give loan or they can collect loan from certain individuals, but technically they can't conduct banking. They can't conduct banking business. But these NBFCs give out a lot of loans. Okay, we have a lot of micro credit institutions. They give a lot of loans. So they give loan like 2 lakhs, 2.5 lakhs, etc. They give loan. So they collect the loans. Now what happens in case of NBFC? Now because 269 ST excludes banks, does the same thing apply to the NBFCs also? The answer is no. So NBFCs, the way they have given exemption to NBFC is that they are saying that each installment is there. Each installment is a separate transaction. So technically, even though I am collecting installments, because it is one single event, means for the whole year there will be multiple installments paid by the borrower. You have to combine all the installments, and that is an event. Technically, clause 3 will get triggered in case of NBFCs collecting installments from the borrower. Clause 3 will get triggered because of the concept of event. So that's the reason why they are saying that the receipt of one installment of loan payment in respect of loan shall constitute a single transaction. So each installment is single transaction, because of which 2 lakhs limit you will get for each of the installments. So that's how they are going to exempt them from the rigors of this section. Next, similar to this one, agriculture, they have given exemption here also. So the cash sales of agricultural produce by its cultivator to the trader of an amount of less than 2 lakhs will not result in disallowance under 40A3, not attract prohibition under 269 SS, and it requires the cultivator to quote the PAN and furnish Form 60. So here they are not saying that you can take more than 2 lakhs, they are saying you have to take within 2 lakhs only, but they are saying that it will be outside, the section 40A3 will not get triggered in case of agricultural situation. Then during 1/4/2021 to 31/5/2021, there was a relaxation with respect to COVID cases. So in hospitals, you could have given cash for treatment. So there's a specific condition applicable to that. So during that time only, you could have given the cash to these organizations. But there also, when you take cash, they had a specific condition that PAN and other etc. should have been collected. So that relaxation was there, but it was only during a. So that is with respect to section 2.
Sale of timber to traders, it is applicable. Section is available.
Sale of timber. Sale of timber, I don't. Sale of timber, I don't think so. It is an agricultural produce. Timber is not, I don't think so it's agriculture produce, like how flower is not an agriculture produce. So I don't think so timber is an agriculture produce. So it will get triggered under. I think we have to see the definition of what is agriculture produce. So like how flower, fisheries, etc. is not part of agriculture. So same way timber production, I have not seen timber production as some commercial activity, I feel. Next, so some other issues. One is like, so the provisions of this 269 ST are applicable to both revenue as well as capital transactions. The only rescue here is what is covered in 269 SS and T, that is outside the purview of ST. That is only this one. And we need further clarity from government with respect to what happens in case you receive you're collecting cash and then you have offered it to tax. What happens in those cases? Are you outside the purview of penalty or not? We don't know. Let's say you are collecting rent, monthly rent, but it is for one occasion or one event. Okay, you're renting. Renting is one occasion. Multiple transactions are there, but it is single occasion. You're collecting more than 2 lakhs in cash. What happens in those cases? What happens in case of gift? It is anyway exempt from provisions, but if you are receiving gift, what happens? Marriage gift, what happens? We have no clear answers on all these practical issues. We have to see how the courts interpret, and based on that we have to take our call. Then with respect to 269 SS to ST, AS, there is a reporting requirement in AS, annual information statement. We have to report that. So 31st May, there is a reporting clause which we need to remember that. 269 SS, 269 T and ST, all three are reportable under 3CD. So that is also something which we need to keep in mind when we come across these sections. Then we have one more section, 269 SU, right? So after UPI was introduced, government wanted to make it more popular. So government said that businesses have to create a channel to accept these payments through these channels. That is, they said that every person carrying on business shall provide facility for accepting payment. They never said that you have to accept, they said that you have to create a facility to accept payment through prescribed electronic modes, in addition to the facility for other electronic modes of payment, if any, being provided by such person. If his total sales, turnover, gross receipts, as the case may be, in business exceeds 50 crore rupees during the immediately preceding previous year. So if you are in business, see your immediately preceding previous year P&L. Is your turnover exceeding 50 crores? If yes, then you have to make provision to receive money in these modes. What are these modes? Debit card powered by RuPay, Unified Payment Interface, Quick Response Code, UPI. So these three channels you have to create channels for receiving money. You have to create channels for receiving money. Now, in case you are in the business of B2B, you are not engaged in meeting the customers, you are in the business of B2B, then what happens in those cases? So government has given an exemption to that. They say that it is hereby clarified that the provisions of section 269 SU shall not be applicable to a specified person having only B2B transactions, okay, and if at least 95% of aggregate of all amounts received, that is B2B, during the previous year. You have to be careful here, it is during the previous year. The SU condition was, that is preceding previous year. So 50 crores crossing was preceding previous year, but here.
Thank you, sir, for the wonderful session. On behalf of ICA Bangalore branch, managing committee members, I, C.A. Chandraprakash, thank you everyone for the active participation and for a wonderful session.